Hey everyone, welcome back to the Capital Mindset Show. Another live, another, you know, terrible week in the market, so to speak. I mean, it's great for me. I feel like it's great. I'm actually enjoying. I don't know if you guys are enjoying what's been going on. I think it's rather entertaining. We'll talk about a bunch of stocks here today because I guess we got quite a bit of a list to go through. Of course, you as the audience can always have your input as to what stocks we do end up focusing on and kind of gearing ourselves towards. But I'll also, just we can relax together. I'm going to be drinking yet again. For some of you out there might know this, I'm going to be drinking this one tonight. Have a little bit of a relaxing time. Have some chocolate with this. So we'll see. We'll have a good time. All right. So I see you guys already had started a conversation. And yes, for those of you who are in the Discord, yeah, that jailbot, I see that you guys are also commenting on that. We've had some problems. We do not know exactly why it's so aggressive. It is very aggressive. It's doing its job in protecting, but maybe it's doing its job a little too well. So the moderator is trying to figure out why the heck that is, because it's really interesting. It's just like, it does not like any references to anything sexual by any stretch of the imagination. So yes. And yes, this is Alcohol Mindset. All right. Welcome to the show, everyone who's new. This is Alcohol Mindset, where we drink alcohol and get drunk publicly. I think it's very important that we normalize this. No, I'm kidding. I'm joking, of course. All right. So the first one I think we'll talk about, and I have received a comment that you guys, it would look better on my end. And actually, let me adjust the camera because now the mirage is being broken. Whatever, we don't care about that. But we'll talk about a couple stocks. I think on the list I have here today is PayPal for sure. And yeah, we have PayPal, a couple of the YouTube index, so to speak. I'm calling it the YouTube index, and we'll discuss what the YouTube index is. And I will be working on releasing the YouTube index quite shortly. I already have an idea of how I'm going to weight it. And originally I was going to weight it based on content approach, but we shall see. All right. So, oh, you're having a Guinness. You see, that's the idea. The idea is that, we get sloshed together. All right, so let me actually proceed in opening mine, and then we shall begin. Okay, and I've heard the feedback from people that not to share my screen on the vertical screen because it doesn't look that good. I do that so I try to look at the camera, because when I put the stream over here and I share my screen over here, I'm obviously have to remember to look at you guys. Okay, but I also want to look at the chat. Okay, so yeah, you can throw ADSK. We can throw that in there. Yep, you see, you're having a Yingling. See, I'm telling you, everyone is joining. This is not Capital Mindset. That's the wrong show. This is Alcohol Mindset, where again we promote public drinking. Okay. All right. Anyways, let me get this pour in, and then I promise we're going to begin. All right. So I think the first one we're going to talk about is PayPal. The point of talking about PayPal is that it's a stock that I've covered in the past, and I haven't had that many positive things to say about it at the time. But prices do change, and prices have come down. And another one we're going to talk about is Salesforce, one that was being mentioned in the Discord channel, which I think is really interesting because it's on my watch list. But let's start with PayPal though. All right, so let me pull up the new tab. Let's go over here, and we'll begin with our conversation. All right, so let me share my screen here. And this should look better. I do take into consideration all complaints, constructive criticisms, all of that jazz. So here we are. So hopefully this looks a lot better than on the vertical screen. So PayPal, we talked about PayPal quite, I'm going off of memory, but a couple times. We talked about it, I think, when it was around yonder after this drop-ish. And we talked about it again. We revisited, I think it was closer to, I mean, you guys can definitely check for yourselves on the Capital Mindset channel, but we talked about PayPal at least a couple times. It wasn't at the right price. It's still, I think it's getting closer, but a lot of other channels were a little bit more bullish on PayPal than at least this channel was. And I spoke about, the competition risk. And let's face it, actually, I was surprised that we are actually very much still in what I was coining, or not me coining, but I think we're still in the liquidity crunch, so to speak. So PayPal and all these other, YouTube stocks, they're very much a victim of that. So taking a look at, we can actually pull it through the model if you guys want, and I think pretty much all of you guys will want that. So let me actually pull up the valuation model, and we can actually do it live, and then we can kind of take requests at that point and run them through the model as well. Let's see here. All right. So I'll put it in here, and then we'll do it one by one. All right. So PayPal seems cheap. We get a comment here. PayPal seems cheap. And let's see here. Okay, so we're gonna keep it to PayPal. We should blaze too. No, we're gonna stick it to alcohol for today. That's beautiful. All right, so just on an outlook on PayPal, yeah, it looks cheap because it's come down a lot, right? But that's a lot of how a lot of people think sometimes. They think, okay, it's down 67%. How much further down can it go? It's up, only 80% over the past 5 years. And I say only jokingly because that is actually market beating performance. It's done tremendously well since that spin out of eBay. A lot of value has been unlocked over since IPO. It's only about what? Is that real? 140%? Okay, I thought it was actually up more over the max period. All right, so let's actually start pulling up PayPal. So let's remove this. No, and PYPL. All right, let's see. Give it some time because, it's just waking up. Haven't used her today. And as soon as I know that the price targets have changed, that's when I know that information's in. Hold on, let me reload it. It's got to wake up. There's a problem with there you go. There's a problem sometimes with the Google Sheets interface. It likes to freak out sometimes. All right. So, because Google Sheets is the face of the model. It's like what makes it look pretty. But so anyways, taking a look at PayPal just right off the cuff, we're already actually priced in. Well, hold on a minute. That 3%, let's get rid of that. All right. So there you guys can see and visualize the growth rates we'd have to assume, assuming absolutely no capital return through the form of buybacks, so no share deletion there. Average growth, they have grown on average in the past 26%, and that's cash flows, I believe. Revenue, we can visualize that there. Estimates on cash flows are expected to actually jolt up a little bit. That makes sense because PayPal, in a lot of ways, is kind of like a toll road. And I always forget to do this, and I apologize. Got to zoom in for you guys. Some of you will watch this on mobile. It's not, let me actually see it because I can actually visualize how it looks like on the camera. That's a good thing about streaming. I can adjust this live. All right, so revenue, we see a positive uptrend. We are below trend line in estimates, right? These are the estimates of on average. And actually, let's revisit the price targets. Price targets are about 167.95, implying a 95.22% upside. So if you trust it just on what the analysts are stating, that's more or less. But of course, here we don't really do that. I don't know. Maybe someone wants to do it that way, but all right, so taking a look at what growth rates we can kind of imply. So they've averaged out about 26%. Going forward, we've talked about a lot of the risks. The risks are, and I believe, competition. So you might be saying that it's too aggressive for something like PayPal, right? 20%, too aggressive of margin of safety. You don't need that much of a margin of safety. Fair enough. So we put it at a 15, and then we'll later put it at a 12. For those of you who actually still don't think this is too much of a margin of safety. But I want to actually highlight that PayPal, we have two competitors that I can think of, Wise and Stripe. Wise and Stripe. And I have this comment here the whole time. So people joining are like, blazing, what's going on? But yes, so with those two competitors, if you kind of combine them together, they basically do a lot of what PayPal does. PayPal is getting into like the Afterpay business model. So keep that in mind. And, I don't personally care too much for that. Something competing like against a firm or even Afterpay. Afterpay, I think, was bought by Block. So then you have that other fintech giant. You also got to be careful. And I've had this discussion with other people in the Discord regarding technology. So technology, I think with disruption, you find it a lot in the B2B segment, not so much in the consumer as much as the B2B. B2B is insane. So in the B2B, you got to keep in mind that businesses are always hyper-focused on keeping down costs. So if a competitor can come around and kind of offer you more or less the same services for, slightly less cost, more efficiencies, et cetera, you can see that change immediately. All right. So you think Apple Pay is the biggest competition? Okay, so very interesting. And I think actually that is correct. It is a competition. I've used Apple Pay here and there. I know that PayPal, for example, owns Venmo. Some of my clients or my ex-clients, I think the ones that paid me on Venmo, were kind of few and far between, but they still used Venmo. Some used Cash App. Apple Pay was actually a popular choice. If I think so, I think looking back, it was a popular choice. And then Zelle. Zelle's a very popular choice. Now, something interesting about Zelle that I've had discussions with people at Bank of America is that they're looking to actually expand the role of Zelle and compete against the large credit card companies. I think actually the mainstream media has been reporting on that too now. But right now, I think it's important to understand the context of Visa and MasterCard. So Visa and MasterCard, one of them, well, actually, no, is Visa that actually spun out of Bank of America, and MasterCard was formulated as a kind of amalgamation of all the different banks coming together and kind of formulating that business, which is an interbank commerce business. Basically is the rails for how the financial system transfers money, and then they spun off these businesses, Visa and MasterCard, as you know them today. Now, Zelle looks like it's following the same destiny, which is actually rather interesting. Yeah, so that's kind of like on a side tangent, kind of overlaying the groundwork of what we're actually looking at here today. So taking a look at in terms of average buybacks over time, they have bought back some shares. We can kind of see that in the visualization down here. So this is, again, ignore that. That's kind of before the company was public. So kind of looking at the more modern time, and you can kind of also see that numerically right here at 0.61%. Oh, and just in case someone wanted to see, here's the management team, and you can kind of just pause the video here and join us later, but there it is. I think PayPal, from what I remember in the videos we looked at in the past, is very well capitalized, good return on invested capital, good return on equity. I think, yeah, definitely. Well, actually, the model's actually at least in the Altman Z-score and in the model's own metric, it is not measuring a safety score that is positive. So not knowing whether or not it's going to go bankrupt, I would kind of say it's probably not, but who knows? All right, so let me go through some of these comments so I don't miss them. Well, DraftKings for this one that I just saw, I'm going to be doing a video on the DraftKings. Right now, I'm going to be focusing on the stocks that are heavily down more recently, right? These bigger blue chips, but I will be doing DraftKings as a video because I have that on the request list. It won second place when I do polls on the Discord. It won second place, so. Also, by the way, there's voting now in the Discord. So you vote on the videos, and I kind of bring up the 5. And then you don't have to be, it's free. There's no paywall to vote, by the way, just so everyone knows. All right, let me see. So I don't want to skip over anyone's questions. Any gamers? Fabio, Google is taking a beating too. Yeah, but Google, the thing is, I'm not selling Google, but I'm also not buying Google here at these prices. I'm kind of just waiting. It's a holding that I'm just not touching it right now, but I'm not going to be adding to Google until it reaches. I think go look at the Google video. I discuss exactly what price I'd be buying or adding to the position. I made it. Playboy has almost been expensive. It's cheap relative to its own historical valuation. Well, historical valuation, there's some issues with that because it could have been just historically overvalued. We're priced in. I don't know if we're priced in necessarily. Magnify, please. Is it magnified now, Twisted? I apologize. I am magnified now to 150%. The company he worked for became PayPal. Yes. You guys are talking about that. Truck stop. Hey, Patrick. Hey, Google it. JPal. Okay. And BP, just so you understand. So no one can say I ignore anyone. Fabio, what qualifies you to talk about stock investing? What's your experience and background? You're making ad revenue off of this. So this makes you a scammer if you're not qualified. Well, I asked you a question, actually. What are the specific qualifications? And I actually am of the belief nothing technically qualifies you per se. But, between you and me, BP, we all know that there's only one person on the internet that is qualified to talk about stocks. And you see, there you go. You mentioned his name. He's the only one qualified to talk about stocks, everyone. So you heard it here, folks. But yeah. So even if I told you necessarily my background, it's still not going to actually, satisfy you in any capacity. So that's why I refrain from doing it. And also, personally, I don't believe that just someone's background, because that's argument from authority, which is a logical fallacy, by the way. So everyone can just judge based on the merit of the conversation, not simply the background per se. Because like if I told you who my employer was, it wouldn't, Yeah, sure, whatever. All right, so no, Elon's company was acquired. Okay, so that's more conversation about that. Feel PayPal is preferred method on buying stuff. Yeah, so PayPal offers that security absolutely from the consumer. Um, Okay, and then do you see levered unfree level kiosks in the DCF model? Well, right now I'm actually using the form of owner's earnings for this one right now, but I can actually adjust it to levered free cash flow, more or less, you know. So yeah, you see Julius Caesar uses unlevered free cash flow. You can kind of customize it to your own. Terry Smith. Okay, so we're going to talk about Corsair. That's already built in. Corsair is definitely going to be talked about in this video for sure. All right. Let's see here. Ollie's actually on the list. So the way I'm doing it is I'm not going to delete the list or anything like that. The list is just the community on Discord is helping me get through it. So they're voting on it. All right. So they're just voting on it. Ollie is on there and it's going to show up in the voting. And I'm going to get through all of them because I don't want to abandon any of the old requests because that would be not cool. Okay. So don't worry. Don't worry. All right. And then skipping to this. No CFA. No CFA license. That is a flex, but it's not really a necessity in the industry. It's more of like a flex. It's no one really like necessarily requires it per se. I mean, obviously there are probably some employers that say, yeah, CFA preferred, stuff like that, but it's more of like a flex. So Fabio, what's your background and experience pertaining to finance? Your audience deserves to know who they are listening to. Well, I don't want to actually say who my next employer is, so I'll just kind of only talk about a little bit about my current employer. But basically, this is kind of what I do on a day-to-day basis and what I'm paid to do. But for a private industry, and not managing anyone's money. I don't ever want to manage anyone's money. That level of responsibility is just not my thing. And both private deals and some public equities, but majority is actually private deals, to be honest. So my next employer has a much bigger name, much fancier name. And I won't be talking about them just yet, but I will be talking about them at some point because working for them comes with restrictions. And I'm doing it for the experience. But yeah, working for them will come with some restrictions as to what I can talk about, but we will cross that bridge when it comes. And I just want to let everyone know here. Of course, I'll be talking about it in greater detail. I won't actually be like I don't even know if I'm going to be able to say technically that I can't talk about that particular company because I think that actually does break some sort of confidentiality. So I'll say this, and all of you can spread this message in the future. If I ignore a request, take that message as it may, that I'm ignoring for a reason. And it's not because I don't like you. It's not because I don't want to do your request. It's because I can't. And if I were to speak about it, I could get in serious legal trouble. Okay. Because I would have information that is not supposed to be had by the public. Okay. So that's the case. And all right, I'm just trying to get through everyone's comments, and no one can say I ignore anyone. So, Fabio, if you don't commit to an argument in the authority logical fallacy, then I counter you with the ad hominem logical fallacy. Yeah, true. Yeah, that's true. And we are going to do Warner Brothers Discovery a little bit because it's part of the streaming. So we are going to talk about it. Don't worry. Because, of course, I'm not going to leave you guys hanging. I'll mention a little bit about Netflix and stuff because I know maybe someone out there has questions about it. And again, that's what these live streams are for you guys to ask more direct questions on the fly, on the cuff. And we have the model here. We can, play around with things. No, I'm not working for Vanguard. I'm not working for Vanguard. But it would be interesting to work for Vanguard. I don't know in what capacity I'd be of use to them, but it'd be interesting to work at Vanguard. It could be financial statements. I'm stuck in. Oh, okay, these are the comments. Fabio, don't take debate. Ignore him. The content and the intentions behind the content is what matters the most. Absolutely, no. That's what I agree. It would be a logical fallacy to state that simply based on someone's credentials that they are simply right, because there's plenty of CFAs, for example, if we're using the CFA as a measure of credentiality, that do espouse some very insane things. The CFA is at the end of the day some form of passing some exams at the end of the day. So same with at the end of the CPA, but there are a lot of plenty of good CPAs. We have several good CPAs in the chat room here today. So all right, so question about ASML. Sure, I'll answer that question about ASML. Oh, I got hired by Meet Kevin. I'm outed. I got hired by Meet Kevin. That's funny. All right, so Fabio, have you heard of ASML Holdings? Worth looking into. Yes, I have, and we've been talking about it on the Discord. Actually, I think there was a bit of confusion in the Discord that I owned ASML. Just so everyone knows, the portfolio has been public for quite some time now. And in there, you could see if I held ASML, and no, I did not. I lost my chocolate. So anyways, BP, what is your previous background and simple education in pertaining to finance? A simple question, Fabio. You can't say that. It has nothing to do with your current employee. Huh? No idea what this means. So no, what is your previous background and education in pertaining to finance? Accounting and finance, both degrees, actually. It actually qualifies me immediately for the CPA because I have enough credits. Okay, so let's get back to the task at hand. Micron, sure, I can cover Micron, certified CPA, certified CPA, certified CPA. All right, yep, let's see how many CPAs we have in here. All right, so going back to PayPal, PayPal's seen a decent drawdown here. 70% and model. Okay, so back to PayPal. Yeah, I'd say that a good price perhaps is closer to the, I think I said this in the last video, but a growth rate I think between 15 and 20% is quite likely for PayPal. But you know, it's also equally as likely to have a midpoint of like 10%, 8%, and the like. So it's definitely something that I'd come back to if we see a further drawdown. PayPal is interesting. It's just a little bit confused on the competition potential. The competition potential is, yeah, I'd say I will get there. But anyways, and I think we can move on to another stock. And the other stock I guess we'll talk about is Corsair, because Corsair's been making some noise here. All right, so Corsair, we kind of can without a doubt conclude that it was a bunch of demand pull and down about 11.8% here today. Incredible. So yeah, you can't answer this. How many hand chance with value stocks? What is this? Fabio, why am I really dumb? It's a simple question, Fabio. You can't answer this. How do you have any chance with valuing stocks? Oh, I have no idea. I guess it's a more complicated question for me than yes. Oh, and I am reviewing Robert, not Robert Kiyosaki, by the way, but what's his name? Rob, the popular investor. I'm reviewing him and his portfolio soon. It got voted the highest, so that's the one that's chosen. And all right, so let's go back to Corsair. All right, so Corsair is down about 17% today. We can kind of see here, very bad downtrend. This stock has been talked about in not the most positive light on this channel, admittedly. So yeah, I think it was very well deserved. There was an interesting misunderstanding within the thesis of other larger YouTubers, which were basically focusing on the revenue growth and the revenue growth as if not looking at, for example, what is priced in or whether or not there was demand pull from more years into the future. But taking a look at what's kind of going on here, I don't think we can deny that any further, that there was a lot of demand pull, and we can see that in sales declining. And I think I've heard plenty of stuff about Eagle Tree Capital. I know of one individual personally who works at Eagle Tree Capital. Won't name drop them, and I mentioned them in the past, but I think that those presumptions about Eagle Tree Capital might be misguided. But I don't know. This individual is not like the head honcho there. He just works there on a lower level. Maybe one day he'll get there, but I know him to be a very moral person. But anyways, regardless, I think there were also some interesting covenants that we discovered or uncovered with Eagle Tree Capital back in one of the videos. I think it was one of the first videos, and that stuff was really interesting. Regarding Corsair today, let's actually go ahead and plug her in, because I believe the fundamentals have significantly deteriorated, unfortunately. So not having fun with that Corsair is going. And here we go. We have a Spaceland saying, I actually think Corsair is going to go bankrupt. Well, we'll actually give a brief opinion on that, but not really. I can't really give an opinion right here, but I'd love to know why you think so. If you want to say, you don't have to say. But taking a look at the price target of 19.16 implies an 18.64% upside. Required rate of return. Okay, we're still discounting it only at 15%. Oh wow, something's going on more recently. The fundamentals are entirely deteriorating. So if we probably try to remove, let's try to just remove that. And let's say Yes, and then you'll understand why I'm doing that in a second. Yes. So we're kind of removing that anomaly. And I have to rename those over there. So sorry about that. I know it might be like, what are you doing over there? But yes. So required rate of return 15%. And let's see here, 15% growth. That growth rate, though, that growth rate is probably not gonna happen right now. Um, there's not enough data to actually conclude an average in growth, but we can kind of see this visualization. Now, estimates are coming down. They are expected to, and they actually just showed that, but a lot of demand pull. Cash flows are a little bit lumpy, so we kind of just normalize those because we just take the most recent cash flows. It's not going to be that good. Now, interesting to note that, okay, shares declined there. Okay, well, I don't know if that will continue, but hopefully they don't dilute into these lower prices. That would be very detrimental to shareholders. And taking a look here, on a P basis, they look rather cheap. On a free cash flow basis, they look expensive. Return on assets, pretty normal for that to be, fairly eh. Return on invested capital is interesting, and return on equity, probably interesting, lower amount of equity probably. All right. Well, with Corsair is a difficult business. I think I stated that it would start to get rather interesting. I like in the 13, that was my original points. But now again, my opinion can always change if the fundamentals do change. So if the facts change, my opinions can change. And if the fundamentals continue to deteriorate, obviously my price of interest would significantly come down. All right. After this, we're going to move into some streaming stocks. And if you guys have any questions about Netflix, that's definitely the time. Um, all right, so let's see. Certified, 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 certified. Trying to just go through these questions, see if anyone has any questions. All right. How strong my personal finance? Corsair, Corsair. Corsair, Corsair. And just BP, yes, accounting and finance. So two degrees, and I almost had a third one in actual biomedical sciences, which is a fun fact. And I've actually answered that in actually the subscriber interview, I think, and other people's channels. And what university? Well, you really want to know a lot of personal information. It's a university where I currently live. That's all I'll say. And GPA my accounting GPA was a 3.8. My finance GPA was I think 3.6 something, and my overall was lower than that because definitely the later classes in biomedical sciences were pretty difficult. Molecular biology, molecular biology was pretty much. Organic chemistry too probably was actually another tough one. I think I got that was another tough one. But yeah, I think I was only missing 3 classes, but then I actually really got my passion for accounting and finance, and I switched over. Plus, also, like, what do you really do with that kind of a degree unless you're going to go to medical school? You know, someone out there is going to be like, well, you can be a lab rat, so to speak. All right. So Corsair investors are running out of horsehair at this point. I'm probably dumping. Okay. So strongman, elements of tomato. Okay. So here we go. Complementary products. Product quality is rather trash and nearing recession. The horizon. I don't really. Yeah. So we've been talking about that for quite some time here. We making some statements regarding what's been going on. So we probably will see some sort of crunch. I don't know the degree of it. We've been saying I clearly do not know, and I don't claim to know how severe it will get. But I think it's fairly certain at this point that we will receive some form of another of a recession. All right. So he see some quick questions. Quick question. Would love to hear your thoughts on O. Love the company. Vici, love the company. Leverage plays on TQQQ. Nah, not so much. Or something that kind of does not make sense to invest in, or something of that kind makes or does not make sense. I mean, okay, so the thing with leverage makes the whole game a little bit more dangerous than really it has to be. You don't need it. So especially if this is kind of a broad brushstroke here, but yeah, just careful with leverage plays. Just be very careful. If your thesis is wrong, you're going to be triple wrong or double wrong, however much is leveraged. Easy to know. All right. Oh, thank you. There we go. Right there. Netflix, right? Yeah, and we'll talk about Netflix. Don't worry. So Disney news in Florida, absolutely. So Disney, we have the DeSantis signed a bill today, removing its special status. I don't really care. I don't really care in either direction. I don't really care in terms of, I don't think Disney's gonna like leave per se. I don't really think it makes a big deal for Disney at the end of the day, like a massive deal. Now, there are some things that are brought up to my attention. I will just say that I've been, getting into that whole whistleblower thing at Disney. I don't know what credence it has. I'd love to hear from the other CPAs out there, all the CPAs in the chat room. If you want to share your opinions, or if you're not familiar with that opinion, go look up the Disney whistleblower regarding the revenues. If she is right, there's a massive amount of misstatement in Disney's, or she's just blowing smoke, right? I would love to know your thoughts, because there are some massive implications if the whistleblower is, telling the truth. Okay, so all right, I guess we'll move on to the stock. So first one we'll talk about is Netflix. All right, so Netflix stock. And you know what? Because we're here already, let's pull up the portfolio. It's good to have it open if we bring up any discussions about this. Capital Mensa portfolio. All right, so we'll put right here. All right, so we'll come back to this, but yes, any questions about Netflix, you guys can just drop them in the comments. But yeah, Disney news already. Yeah, just covered that. What's this? Can you talk about special items going up in general past few years, share-based compensation? Okay, so you're talking about you've noticed the trend of share-based compensation increasing. I want to know exactly what angle you want me to speak on that, because I can speak on that in many different angles, from the perspective of the investor, from the perspective of management team. I just need that bit of question answered. All right, so Fabio, what do you think will happen to precious metal if the Fed raises rates? Absolutely zero clue. Not my specialty. Zero clue. Absolutely nothing. I'll tell you this. I have a collection just for fun of shiny rocks, and well, in form of coins. So that's about it. That's my exposure. I have a collection, but they're for fun, not really for speculation. Amazon, it's a holding in the portfolio. I'll show you right now. And let me zoom in, because I hear your pleas. All right, Amazon's right there. Boom, 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 boom. It is 2.11% currently of the portfolio as of today's close. And it's not updated today, but I didn't really make any purchases in the last 2 days, so it doesn't matter. Yes. Oh, yeah. So let's go ahead and talk about Netflix. So Netflix, we all know, for those of you who don't know somehow, Netflix has crashed from all-time highs to about 68.65%. And this is after we had this wonderful man, and I'll actually find him, because I think it's a really interesting watch if you get the chance. But here we go. Joseph Sun NFLX. $100. All right, I don't want to play the volume, so I'm going to be careful and pause it there and then bring it here, yonder. All right, it's enough of that. All right, so Netflix, why Netflix will $900 per share will happen. I discussed this in the video dedicated to Netflix. And with that being said, this is, again, just so everyone who didn't see that video, is a perfect example of a story-driven investor. We can have our own discussion about him. You can ask those kinds of questions if you so choose. But yes, speaking directly on Netflix, again, we see this massive sell-off. We see that users is declining, right? The quantity or amount of people appears to be stagnant at the very least, even when we bring back Russia, because they only grew like a couple 100,000, something like that. So even then, when you exclude Russia, it's still concerning. So I love to know that. I love to know this. I'm sorry, I just have to bring this up. I'm so blessed. No, but seriously. All right. So Netflix, $900 per share. I want to actually see, the price was about $533. So this is, again, example of when we allow ourselves to be kind of consumed by the story and remove ourselves from the analytical approach. So I believe that there's a balance to be had in some form or another. I've seen some comments that brought up some interesting points regarding maybe the balance should be more skewed in one direction or another. All of those are subjective, because this is an art and a science. So yeah, just kind of encroaching upon what Netflix kind of offers is, I've been noticing a lot of people are getting really negative. And just to remind everyone, if you take a look at the portfolio here, it is actually only making up 3.16% as of the additions to the portfolio. So, and this is after when we include the sell-offs, or not the sell-offs, the taking of profits of ConocoPhillips and BHP, which were both together a decent size of the portfolio, over 10% of the portfolio together. So after we consider that sell-off, or that, I keep saying sell-off, it's not the right word to use. After we consider that profit taking, it was down there. And then when we saw this crash, which if you go see all of the Netflix videos, there was a kind of a wanting for something like this to happen. And it's finally here, but let's be very clear. I still don't think it's right there. All right. So it's not right there. And if you go check out that Netflix video, I do say the price I'm interested in Netflix, but it's not there yet. Spoiler alert. All right. So again, the theme of this is there is a lot of exuberance from some creators, and I think there's also becoming a lot of pessimism, which I started to notice in the comments section. I like to, for example, just kind of try my best to be objective and look at the data, look at, what is it that people are watching, what are the top shows, and that kind of drives my investment, because I know this is a thing I see a lot of people do, is the anecdotal evidence. Relying on anecdotal evidence to then justify investment decisions can be a big mistake. I'm guilty of it too. I was guilty of it in the past. I've done it in the past. An example of this is you go to a store, like, let's say, hypothetically, completely unrelated, and you can't relate this to anything at all. I promise you, you go to Target, and then you watch a person, pick up a box of a vegan food product. You see, like, this, we can't relate this to anything, and we can't say that anyone else really does this. But hypothetically, let's say there was a person that went to, Target, hypothetically, and they saw someone purchasing a box of frozen food, and then they made the conclusion that said company was going to be very, very successful. That would be an example of allowing anecdotal evidence to drive investment decisions, okay, hypothetically, because maybe, perhaps, the data doesn't actually show that it's necessarily the case, right? So we want to be very careful. And social scientists, or scientists in general, are very cautious about anecdotal data, all right? So we as investors should be too, right? Why not? Why would we rely too much on anecdotal? Anecdotal can probably give us the idea for it, like, Peter Lynch style. You see someone buying it, maybe it introduces you to that idea of it, and then you investigate further. And then upon that investigation, hopefully at that point, you've made a good decision. All right. So, okay. So going back to, again, Netflix, we've been having this guy open for a while, but I wonder what the comments are around here. Well, it's interesting. Very small amount of comments for the size of his channel. I think, he's a fairly large channel, 56,000. And this is his after hours. He has a bigger channel. But anyways, regardless, I will be doing a review on him because he has been requested several times. So I will be reviewing all of his portfolio. Do not worry. The one that is taking priority now is Robert. Robert from the Popular Investor. He is taking priority. So I won't put Netflix into the model because it's been recently put, and I'll actually kind of segue us over. And by the way, Warner Brothers Discovery will not function right now in the model. The numbers have to come out. Just want everyone to know that. But we can discuss it on kind of like a bird's eye view. So WBD. All right, so WBD is part of the portfolio and is down 4% today. So let's go back to the portfolio. Let's find WBD. I think WBD is close to the same size. It was actually sanctioned off to be sold a little bit, and I probably should have done that. But, hindsight, whatever. And it's still called Discovery. The name is still porting in as Discovery. But there's the ticker. The ticker is right. And so, yeah, it is down actually 13.82%. It makes up 2.2% of the portfolio currently. And the thesis behind Warner Bros. Discovery is that they have a massive library of content. And I actually want to preface this point because I don't think it was taken too strongly, or at least some people didn't probably get this point, where the advantage of Disney and Warner Brothers Discovery, I apologize, Warner Brothers Discovery have over Netflix is that they have the box office, right? So when they produce content, and we talked about this in the Disney video, particularly more recently, and I forgot to mention this in the Netflix video, which is actually a big drawdown to Netflix, is when Disney spends that $33 billion in content spend. Let's think about this logically. What happens when they, spend, let's say, $1 billion on a movie, on a big movie? Well, then it goes to the box office, and at the box office, it can recuperate its costs And then on top of that, it can actually potentially generate an income. So it can have actually a positive value added for guaranteed right there. Not guaranteed, but you know what I mean. It already recuperates the money and you're done. You covered your costs. And now you have a piece of content that you can grab and put it into your streaming platform. That's very powerful. Okay, so do not underestimate that Warner's Brothers Discovery, Disney, and these other ones do that Netflix does not currently do. I think if Netflix were to try to do that, it'd be very interesting because right now, for example, they made that movie, that big blockbuster movie with The Rock, Gal Gadot, and whatever, Ryan Reynolds, right? That was a very expensive movie, and they made one movie. And the thing is, you watch content and you watch it for an hour and a half, and you're done. Right? That's it. You're done. And then now you need the next one. But they didn't recuperate any of that costs. That cost is recuperated implicitly in the amount of people subscribed. Okay, so very important to note that. I think it's very, very important that we understand that is a weakness to Netflix, as much as some might think it's a strength, being a subscription-only business. Okay, so there was a little bit of an arbitrage, Will P. We talked about it in last videos, and at least other subscribers also brought it up in comments and stuff like that. Even brought it up here in the live chats here. All right, you bullish on Sleep Member stock because Strongman's going to sleep ever. You see, yeah, that's a good example. And Delicious immediately looked up the Purdue company. Sadly, it's private. Yeah, I mean, sometimes these companies that are really good are private, unfortunately. And I see some of you clearly got what I was referring to. Oh yes, and don't forget to smash the like button if you want to. Thank you, Patrick, for reminding everyone. The only gold I have is Amex Gold, 90K points. Really, is it up that much? Wow. I mean, I remember back in the day when it was 50K. Now it's 90K. Huh. That's crazy. All right, so let's put ASML in the model. We'll definitely actually, yeah. Let's just go ahead and do it. Fine. All right, so just warning you, I know it's going to be expensive. I already looked at it on my own. All right, so just give it some time while I'm talking about random stuff. Oh no, I already did it. Thank goodness it was fast. You're showing off today in front of the audience. All right, so strong buy by analysts. Price target about 609. Okay, cool. And let's remove that, and let's remove that. All right, again, I got to rename those. Misleading having those names. All right, so average growth of the past years, that's a 40%. Jeez Louise. All right, so anyways, actually, no way. I mean, has it dropped? I haven't checked the price. Let me check the price. No way. It used to be bad. Look at this. We're doing it live. There's a surprise here. I'm completely surprised. I literally thought ASML was like going to be garbage. All right. It's not saying it's a buy. But like I thought it was going to be like garbage. Oh wow, it is down. It's been a while. Yeah, it's down. I completely have not looked at this company. I think I was looking at around here. It's $100 less. I remember it being like 800, 700. So interesting. All right, let's go back here. Now I'm interested. All right, ASML. All right, we're discounting at 15%. They are doing like token buybacks, so let's just put that in there, I guess. All right, yeah, barely budged anything. Can they grow at 20%? I don't know. Maybe. All right, let's see what we can eke out of here. 17, 18. Oh no, not 189. 18. Yeah, we're basically like on the upper edges. So basically, we're on the upper edges because I think like 20% might be. Yeah, I don't think they're going to grow at like 40% because let's be honest. Let's be real. This level of growth is probably behind them to some extent. Cash flows are actually estimated to come down a little bit here, and that's with the order dropping probably. So again, I wouldn't assume that they would grow at the same levels as in the past. And actually, here's my answer. My answer is right there. Look at this massive growth. So I doubt. Yeah, there you go. Analysis there. See, we're walking through this analysis. I definitely would not be assuming anywhere close to that because we're probably going to return to trend line, my friends. We're going to return to trend line. So we're probably going to come back here and then trend back up in growth at some point in the future when chips recover. Okay, so yeah, I'd probably want either greater margin of safety or just assume lower growth rates. One or the other. But yeah, I think 15 is fine. And then 10% is really low. I think like 50% is quite reasonable. So I'd say, rough estimate. I have to do more in-depth research, but like 400 and below would probably be interesting. That's all I'll say. Interesting. Okay. I mean, some of these numbers are absolutely ridiculous. Like, what is this? 60%? What 69%? What is this? Return on equity? And this is based off of, I think, cash flows right now. Potential value. Blah, 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 blah. Oh yeah, this thing's not going away. This thing's not going away. Two confirmations right there. Let's hide this so I can actually come over here. No, we don't want that. 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 What do we want? Here we go. All right. So this will go mention sentiment score. Okay, we have a positive sentiment score. Oh, you like that? The 69%. Yeah, it's amazing. It just works out that way. 7. Okay, cool. Yeah, sentiment's barely mentioned. That's fine. All right. So I will also go over because let's take a look at this one. We've talked about AMD. AMD, you know. I want AMD. I would like to have AMD. I would like to have NVIDIA. NVIDIA is my favorite, but AMD I would also like to have just at the right price. And I want to remind everyone how wrong I was for quite some time. I made a video around here, and it just like blew up like 50%. No one called me out on it. None of you guys called me out on it. You guys weren't like, you were so wrong on that. But later, not even a year later, we were down 13, now 14% around there. So pretty great. Let's actually plug her in to the model, and let's see what the gods provide. Yeah, I'd probably before we actually look into it, I'd probably expect it to drop further. And by the way, I see your comment here, Zastar. Absolutely agree with this because you have to take a look at their customers. Their customers will give you a good idea as to who is or maybe what they're going to probably have a problem with. And ASML's customers, I think Intel reported the same thing, AMD reported the same thing, I think NVIDIA reported the same thing, that they have declining order numbers. And that's a bit of a problem. And then that kind of trickles down into the guys who service them, which is stuff like ASML. So Intel specifically, because AMD is a fabless and NVIDIA is fabless, I think, as well. I'm pretty sure NVIDIA is fabless. And so they're not the direct customers, but they impact the customer, which is like Taiwan Semi and Samsung. So, and I don't want to Global Founders. I don't want to leave them out. I didn't mean to leave them out. All right, Facebook will be added in here. Don't worry, we'll do that one. So AMD, it's already loaded in. Price target about 118.67% according to analysts, implying 34.64%. They're infallible. Just trust the analysts. And taking a look at return on assets, return on equity, pretty good numbers there. Of course, we know that about AMD. AMD looking expensive on a PE basis, expensive on a price to free cash flow. But how much will they grow? Okay, so this is taking a look at them cash flows. All right, so let's take a look. What the heck is going on here? All right, so that is weird. Are you taking into account growth model? What are you looking at? What are you looking at? Yeah, no. That's probably like some fluke that it's measuring from some time back here. Yeah, it's probably measuring from some time back there. It's taking into account a long period of time. All right, so ignore that for now. Average buybacks. Okay, so yeah, they have been net dilutive, and I think they will still be a bit dilutive going forward because it is a cheap source of capital, especially if you think the company is a little bit on the more expensive side in a current basis on a yield basis. And when I'm talking about that, I'm talking about earnings yield, cash flow yield, stuff like that. But taking a look at the growth rates, AMD I think has grown between 50 and above, or 40 and above % more recently, and I think they're projected to grow at about 20 to 30% into the future. Well, for the near future. Now, the short-term stuff, a little concerning, but I'd say that at a 20% ish, yeah, that's pretty. I mean, yeah, because we're taking a look at the current multiples. The current multiples are not the best. I mean, the projections are that they're going to rocket up higher. So, I'd probably say this is definitely not a thing. This is not going to be a thing. I'd say probably low end is like 15-ish%, and then let's say higher end is like 40-ish%. So if they can achieve that 40% historical rate, yeah, we're in the buy zone here, even with assuming that dilution. But let's see, plug in 35. Yeah, even with a 35, we're in the green zone. 30%, we're getting there. We're close. We're very close. We can probably get there. And again, this is if you have this margin safety, you can lower it and you can kind of see how them numbers play out, and then you can lower it even further at a market rate. And by the way, I actually want to make this point right now. WBD will not function right now because I don't think the numbers are out. So that's why I didn't do it when I brought it up. Okay, Patrick, I see your your request there. Um, but yes, so what was I saying just now? Advanced micro devices. I had you up here. Yes. Yes. So market rate of return 10%. I don't think that is an actual rate of return. I think projections for market rate of return are actually in the negative for the next 10 years, unfortunately. So, but oh yeah, but Patrick, just so you know, when it is, I will be doing a video on it, because when the numbers come out, oh yes, I'll be there. And but yes, okay, but yes. But yeah, 10%, I actually think it is used as a barometer to measure the average market rate of return by a lot of even analysts, and even in an academic setting. I remember my old professor for portfolio management, he used, or he made us use, a 10% kind of measuring stick for the market. And that's based off of data from the past, but really looking at forward potential, I don't think it's exactly 10%. And if you really look at, for example, trend line, right? We're probably going to revert to trend line at some point. And trend line implies, if we revert to trend line, it implies a bit muted returns for the market index, at least the United States market index. And I don't think it's just me that's been saying that by any stretch of the imagination. This is pretty public. I think JP Morgan even publicly stated as such. Of course, them saying it makes it almost, maybe a lot of people believe that that's not going to happen. Yeah, but I like to take it, each argument in isolation and kind of judge it on its own merit. But I think that's very likely. All right, so let's review Facebook, because Facebook, just to have the portfolio up, I like having it up here. And actually, I also will talk about a little bit about Citigroup, because Citigroup, we got to talk about the banks. We have to talk about the banks. All the banks are kind of coming down, and a lot of people. We've talked about this in past videos. I hope everyone remembers, what did we talk about when it comes to interest rates? Well, we talked about how interest rates don't necessarily mean good things for banks, right? Don't necessarily. I love that comment. Yes. Yes. That is a person who's predicted quite literally everything. So, all right. So, but yes, going back to, we'll get to the banks. So I won't forget, we're going to the banks. We're focusing on Facebook right now. So Facebook, where are you at? Where are you at, Facebook? Right there. Or keep calling it Facebook. It is Meta. We have to respect its new name. All right. Wow. Look at that. All right. So we are approaching my point of great accumulation, so to speak. And my great accumulation, it's no secret, is about 160 and below. So I'm very excited for that. And I think we will finally get it. And look at that. I rose my cost basis. I ruined my cost basis by adding. I'm so upset. I'm just kidding. I'm not upset adding Facebook. Facebook's sitting at about 7% of the portfolio. It's not my biggest holding. My biggest holding is still Alphabet. And Alphabet is just not one I'm going to sell. Oh, and look at that. It's down to 23. Fantastic. All right. But it's still not at the price. And I'm completely okay with it coming down. I'm already happy with, all the profits I made this year on just energy and mining. I don't really want to incur any more taxes. No more taxes, please, IRS. All right. So anyways, what else? Oh, I'm getting off track. Facebook. Let's stick to Facebook. So, or Meta. There I go, disrespecting it again. Let's go look at the price action. So up to Meta platforms, we're down another 2% here today, but taking a look, they've had a terrible year, really terrible year. So, see here down 45%, on the 5-year up only 22%. So now it is underperforming. On the max, I think it's doing pretty okay, but still not the best. And the thing is, I think Meta is now focusing finally on actually buying Facebook shares back. And then so I have some questions here regarding Facebook, so I'll focus on those right now, and then I'll go back to the other ones. So do you don't think the fundamentals changed on Facebook though, or Meta? Some yes, and some no. All right, some yes, some no. I think that the moment, and it's not, you see, like, let me be very clear, it's not going to be the largest position in my portfolio. It doesn't have that level of conviction behind it, but it can get pretty large depending on the price, and that's the key word I want to leave with you on that before we actually get into the valuation. Depending on the price will determine its size, and that's as easy as I can make it sound. But at the current prices, I'm satisfied with its position sizing. At lower prices, that story begins to change, because everything has a price at which we are valued at. It's definitely not worth today $300. Absolutely not. And when we originally made that video on Facebook, when I think Everything Money, correct me if I'm wrong, everyone, because I don't want to misquote anyone, but I believe Everything Money stated that Facebook was somewhat of a buy in the upper 200 range. I think the mid 200 range, which I disagree with. I vehemently disagree with that because there, and I'm pretty much on video saying that. I did not agree with the margin of safety implied in that price. So we need to um, think about that when we get the price. The price is absolutely, and is this? Are you referring to my comment, Julius? Am I correct in saying that? Because I don't want to misquote anyone. I want to actually argue on what people actually say. All right. So I could be completely wrong, but if you're referring to me, Julius, then yes. Okay. So in that sense, yes. But that again goes with, well, I won't roast on it too hard, but there's issues with levels of analysis. But anyway, regardless, aside from that, we're not getting into that. So Facebook, I think it's approaching a point where the world is getting a bit very pessimistic. We've approached times like this before. I want to zoom in to this time because I remember this time a lot of people saying Facebook's done for, it's terrible. And what is this downtrot right here? Yeah, about 40%. So very similar scenario right here. I'm not saying this is the bottom. I just want to be very clear because I don't want someone to conclude, oh, you're saying it did that move, now it's going to do this move. No, I'm not saying that at all. But it's not about Facebook per se, because I see another comment come in here that you don't think we could see user number decline in Facebook. No, I think we could. I think that's basically what people are anticipating. But the thing is, for example, take a look at linear TV. Linear TV ad rates are absolutely ridiculous when they don't really have the attention that these other applications do. They don't have the ability to target as these other applications do. Now, we could say for a second, because it's very valid, hey, well, they're being blocked by Apple and they're being blocked by Google. Well, there's other ways of actually getting that data, because when you go on, for example, Instagram, I think Instagram is widely used, still very widely used in the world. And I think also Americans, from the Americans' perspective, need to understand the amount of things that Facebook owns, and the options out there are pretty much, you got Snapchat, and Americans really like Snapchat. Snapchat's widely used in the United States, but globally, other things are used. TikTok's being very successful. TikTok's actually making a threat. Snapchat, I wouldn't say is necessarily a threat. It's not a global threat. It's a domestic threat. But yeah, just take a look in isolation. We have WhatsApp. WhatsApp's absolutely insane. Do you guys know how many people use WhatsApp? Instagram, again. Facebook, people still use it for groups. People still use it for marketplace. I still use it for marketplace. I don't use it for anything else besides marketplace. Anything else, I don't really care for Facebook. And here I am just buying up meta shares. The thing is, you got to understand that those are the cash cow businesses. And so there is a value, a terminal value to these cash cows. There is a point at which they will probably die, but that's some point in the future. And there's still a value to be realized from that. And it still will generate income that then Facebook segues over into their other businesses, other acquisitions, etc. And we will see this gamble on the metaverse. And people there's the meme version of the metaverse. I've discussed this in past videos. So there's what people think, these NFTs, you become this figurine or whatever the heck. That's the funny one. But in a more serious note, the metaverse is a very large and complicated and in-depth business-to-business solutions. It's basically like, think of it like the Internet 2.0. There's a lot of companies, and you think of it like this. Who else is working on it? Well, you have Adobe. Adobe's working on their own version. And then it starts to make more sense, right? Then you see Dropbox. What is Dropbox doing? Well, Dropbox, they're trying to cater products to the eventual metaverse. Of course, there's the fun side that Facebook is doing, and Facebook's kind of doing this as, I think, a marketing ploy so that when individuals out there think of the metaverse, they think of Facebook, for example. Keep saying Facebook, but they think of Meta platforms, and it's just positioning themselves to what they think is going to be the future. It's a clever business move that we think is idiotic now, and I think most people laughed at him or laughed at the idea at the time. But there's a lot of ideas that people really laugh at the time that kind of go out to be like, oh, well, that made sense, right? I think in this, it might be one move that ends up making sense. Changing their name to Meta was a good marketing ploy, just simply for getting the name. And then so when you think of Adobe Meta, the Adobe Metaverse, it doesn't roll off the tongue. It's not as easy to say as just Meta, the Metaverse, Meta's Metaverse, right? They won't be called Meta's Metaverse, but when you think of Meta Systems, you're probably going to think of metaverse. And so there's going to be massive competition in this space. It's not saying that Facebook is guaranteed to win, but they have a massive amount of a huge war chest, right? So does Google. Google has a huge war chest. Google is my largest holding. So does Microsoft. Microsoft has a massive war chest. Adobe, not so much, but very respectable. I think who else? I'd be scared of Salesforce. Not scared of. I'd be scared if I was Salesforce. Salesforce is, I think, kind of slacking. But yes, yeah. So I think Salesforce has a lot to worry about in the future, because like Salesforce, for those of you who don't know, is kind of like a platform of sorts. But there's a lot of businesses built on top of the Salesforce platform, like Viva Systems. Viva Systems, I think I've mentioned them in the past. They're a healthcare CRM solution that is built upon the Salesforce platform. Think similar to how Metaverse or Meta wants to be, where people build applications on top of their stuff, and then you provide all of this like ecosystem, right? A lot of B2B solutions, and the thing is, it also acts as a consumer solution. So that's the added thing. And the consumer solution is great at bringing in thoughts, marketing, bringing people into thinking about you. And then don't underestimate how that actually works in the real world when employees go out and work, and then they're at their employment. They're like, okay, we need to have this B2B solution. Who do we pick? Then their personal life, they know about the metaverse, and they go, oh, okay, fine, we'll choose them. So that has all these added benefits that can proliferate. So that's basically what. Oh, and no respect for Roblox. No, I forgot to mention Roblox. But Roblox is a smaller player in that, but definitely that one is more focused on the consumer side of the metaverse. Okay, the consumer side, because I'm saying Meta company, Meta Systems, is focusing on the whole aspect. So B2B, B2C, etc. All right. And yeah, TikTok, sure, it's taking over. TikTok's trying to come after, I think, Netflix. I did not. What? Yeah, I did not see that. That's insane. 4,600 intrinsic value today. That's insane. That is insane. Mm. I don't want to make it like a sales pitch. So let me kind of counterbalance all of the things I just said, Bob. So, but yes, so I'll kind of counterbalance, because I really don't like to, only be positive on stocks. And it's very important, very, 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 very important. We focus on the negatives. The big negative is the Meta doesn't pan out. The other competitors actually destroy them. I think, for example, I'd be terrified of Google, Microsoft, because when I think of war chests, right, and even Adobe, don't think that a small player can't win. And let me just say, Roblox, maybe, finally, sometimes that can win. Heck, I don't know, Tesla, I don't know. But just taking a look at these bigger competitors, Google, I mean, that's a monster. I'd be terrified of Google and Microsoft. They just have like endless money for days. But I hope Google is a perfect evidence that having tons of capital doesn't mean you're going to win. It's absolutely not the case. Just because you have a massive fortress that you're going to win at everything. So you can fail, and you can just fail very spectacularly. But of course, the idea is hopefully you can afford to fail spectacularly. And Google can afford. Meta, to a large extent, can also afford that too. So how does WhatsApp make money? So WhatsApp makes money from a variety of ways. They're trying to monetize it more. I want WhatsApp. This is my vision for WhatsApp. And I'm saying this as like, if I see management heading towards this, I feel even more confidence with Facebook's management team. But I want them to kind of peer off, and this actually getting us back to PayPal, and compete with Venmo and PayPal. I want them to do that. I want them to make it easy for me to talk to, and I talk to everyone of Capital Mindset, this Capital Mindset organization, so to speak. Oh gosh, another fake financial education account is trying to follow me. These are absolutely hilarious. Yeah, these are absolutely hilarious. This one is definitely not him. It's just on Instagram. Yeah, it's just posts. Oh gosh, this is so cringe. It's like these guys think that they're it's so easy to, all right, whatever. But anyways, I want them to make it super easy for me to communicate. And the reason why I just picked up my phone to kind of emulate this and talk to other people who maybe I'm hiring, and I can speak to them, and I can send them money very easily. That's what I envision for WhatsApp, in a very secure manner. And they are doing that in some countries. I want them to kind of expand upon it, make merchant solutions, make WhatsApp easy, seamless, kind of like You know what? Copy WeChat. Copy WeChat in China. That's what I want WhatsApp to be. Exactly that. Make it very easy and seamless for me to transact through you, and we're good to go. And they're working towards that. I do see that, and I know that they're, for example, rolling that out in a lot of countries. I want it to be global, and I want it to, because it's not really like important that in the United States. It's important that they get that in other countries where it's really used, and there's a lot of underbanked citizens. Turns Facebook and or Meta, there you go again, into yeah. Nike will be selling their clothes and shoes. Yeah, exactly. I mean, hey, you don't underestimate how much people spend on virtual stuff. Look at Grand Theft Auto. Grand Theft Auto should be clear evidence that people are willing to pay a ton of money just for virtual, yachts, virtual cars, and pay real money. We're talking. All right. Okay, so looking coronavirus, you can't catch the coronavirus in the metaverse, at least as far as I know. Then stream's gonna get shut down because I'm just kidding. All right, Fabio, seriously, how did Ackman get Netflix so wrong? I don't understand it. If you worked for him and he listened to you, he would have saved himself 400 million. Make it make sense to me. Well, thank you for I guess the compliment. I mean, Bill Ackman, if you're listening to this video, I'd work for you. I assume that working under you pays very well. Heck yeah, let's do it. Let's make it happen. But anyways, well, after I'm done with my current commitment, but regardless, I think that he got, I guess, a little ahead of his skis. He might gotten a little bit more emotional. I don't know what his models were doing, so I really can't answer that. I have to actually like see what's going on in his model because everyone's model is different, man. You can design models vastly different. So some models are not very adaptable, and that can cause a problem. I think, for example, fundamentally, he wanted only a subscription-based platform. When they segued over to something else where they're saying, "Oh, we're going to do advertisements," that's like, I'm done. I'm done. And I think Twisted Leather exactly said it. It might be a degree of hubris right here. So it might be a degree of hubris, and maybe I just I don't exactly know what the heck happened there. To me, it just didn't make sense. But I've seen other super investors, I had to use that in air quotes, not to offend them, but that's the name that they're given. For example, I did not understand Monish Fabrai's investments in various entities. I just didn't understand it. Doesn't mean he's a bad investor. I wouldn't say or dare to say that. I have yet to prove myself to any degree to even be able to say something like that. But I can have my disagreements. I don't just blindly believe an individual because they've achieved, as I don't think any of you should. Even, for example, let's say, hypothetically, I do perform extremely well over the course of my life, and I'm still doing capital mindset at that time. Even at the end of my life, I would not say that just because I have a track record means that I am then, and this is going back to that other individual is comments. It would be an argument from authority to say simply because of my track record that I am right. you know. So it goes to show, Bill Ackman can have great performance. He can make mistakes. Monish Pabrai can have great performance. He can make mistakes. Charlie Munger can have great performance. He can make mistakes. Everyone is capable of making mistakes. We should judge the arguments on the merit, and that's about it. All right. And I see some arguments. Pabrai is overrated. Okay, all these things I can agree with. What Bill Ackman sold out of Netflix pile to Tattooed Chef. Can you imagine if he just announced tomorrow the movement Tattooed Chef would have? The movement. And let's talk about Tattooed Chef. I think we should talk about Tattooed Chef. Oh, yes, we're talking about Tattooed. Oh, I can't even spell Tattooed Chef. The alcohol is kicking in, guys. The public intoxication, it's just kicking in. Mm. All right, so let's take a look at Tattooed Chef, down 5% today. It's down now below 9.09. So I will begin by saying the argument in and of itself is not and should not be that Tattooed Chef is down, therefore it is a bad stock. No, 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 because that is an easy cop-out way for supporters of this company to then say short-term price action is not indicative of the quality of a business, because that's absolutely true. I would say, the same thing with like Netflix. At the end of the day, I don't think anyone can say, maybe you can make the argument that it's not a good business, right? Let's not say it's a fantastic business, because I don't think it's a fantastic business yet, has the potential to be, but it's a decent business. Like none of you wouldn't mind to hold all of Netflix or own the entirety of Netflix and have all those employees and all those people working. But like that's my kind of my barometer. Would I like to actually own the whole thing? And if I say yes, and it's like probably it's a good business, right? Probably It's a pretty good business, regardless of price. Like if I was gifted the shares tomorrow, and let's say I wasn't able to sell, but I could realize the value produced by the business, we're kind of adding more restrictions there, but for a reason for this example. All right, but sticking to Tattooed Chef, this is a business I wouldn't really want to own the entirety of, right? And again, in this example, I can't really just go and dump my shares. Obviously, if I could dump my shares, you give me 770 million. Yeah, maybe. But let's say in this hypothetical, I own the business and it's private and I have to deal with all the stress and all that. No, no, no. I probably wouldn't want this one. I'd rather stick to my current stuff. So yeah, Tattooed Chefs down about 5.02% here today, and I think we can. I go over here. Let's do TTCF. Let's pull it up, and I think I put this at 10%. This would put at 4 years, and we are doing an unprofitable analysis because it's not profitable yet. So yeah, surprise, surprise. Take a look at those growth rates, boys. All right, so 10%. I think this is actually fairly okay. Maybe conservative, having a 10% dilution rate. Sorry, not 10%, 2% dilution rate. I apologize. 15% discount, and I think that's still not enough because this is kind of like a ball of potential, if anything. Because okay, where am I getting that 10% from? I just want to be very clear because I mentioned this in the Tattooed Chef videos, but just in case for everyone new, I always want to accommodate or try to be as accommodative as possible. But Tattooed Chef, I'm basically saying that they're going to reach Conagra levels of margins, right? And I'm saying they're going to achieve in 4 years. Might be aggressive, yes, but that's the point. The point is to be aggressive here because I'm trying to make a point here on the valuation. So remember, the argument is not stemming from the price go down, therefore bad. We're going to stem the argument from the fundamentals, right? The fundamentals of the business, and based off the growth potentials, what we can model out over long periods of time. How does that pan out? All right. So do you think Apple and Microsoft are holding the indexes up? So I just see this comment here. It's kind of a difficult question to answer. So, I could be absolutely wrong when I answer your question, Dark Knight. But basically, I think that there's a massive possibility that yes, you have. But now I don't know. They're going to come down. Google was up there holding it up. And what is Amazon at? Amazon, I think, probably is up there. Has it corrected a little bit? Let's see. Yeah, it's corrected a little bit. So Amazon, Google, Microsoft, Apple, these guys were all holding up the index. We saw the first one to fall was Facebook. That was the first one to fall. So I'll admit that. Then we see, Netflix fell. We have CRM, which is another large business. CRM also fell. CRM is at 171. We'll talk about you in a second, CRM. Don't worry. We're not ignoring you on purpose. NVIDIA is down too. Look at that. So NVIDIA is down from, look at that, 31%. Who else? Who else a big boy? I'm thinking about the big boys right now. What's Visa at? Visa is a big boy too. Visa is kind of like stagnated. MasterCard, another big boy. Let's see that one. Okay, 351, kind of stagnated too. Big boys. Who are the big boys? Oh, BRKB. Yeah, it's kind of like normal. Yeah. What's that? Yeah, it's barely moving. Yeah, this is an index on its own almost. BBC is holding up. BRKB, we can talk about BRKB. I just saw this question. I just brought it up, but yeah, I hope that answers that question. Let's finish up Tattooed Chef here discussion. But yeah, this growth rate, like this was apparently the thesis. The thesis was predicated. And by the way, I just want to state, if any of you are invested, but you're newer to the markets and you invested in Tattooed Chef, or when I say new to the markets, I think under like 4 years. Under 4 years is fairly new. So if you were watching, very entertaining channels, and I will not take that away from that person. That person is entertaining, as I've stated. You're supporting more Molson Coors. Sorry, everyone. We have to stop Molson Coors because this is the holding right here. Not Sam. I almost said Sam because I'm reading your comment too, Julius. my mind. Oh, there's the alcohol making me stutter. Just kidding. But Molson Coors Brewery, that is a holding here. We're finally up. It was for a while. It was just stagnant or down. But yes, thank you for supporting my local small business. It's a joke among my friends when they buy something that I own. I say thank you for supporting my local small business, and I name the company. And then I usually maybe put a little phrase in there about what they are. So like, for example, if it's Molson Coors Brewery, I'll say thank you, like literally, quite literally to you. Thank you for supporting my local small business brewery. Right there. That would be like the full extent of what I'd say. All right. So uh, kind of finishing off Tattooed Chef. Let's see what else. Oh, look at that. Look at that analyst price target implying 42% upside. But yes, this individual's thesis was predicated upon revenue growth. And like I was saying, very entertaining channel. So I don't blame anyone who's newer to the markets for listening to that. That was a motivation, a big motivation to start Capital Mindset. It was in the conjunction with a couple close friends of mine who were getting new into the market. And I saw that they were, getting information from YouTube. And I was already working where I work, and I just never had conversations with these friends about stocks. But then I didn't know that they were interested in stocks. And when I found out they were interested in stocks, then we started to see like where a lot of them were getting information from. And I remember it was very hard to convince one in particular, which was a good friend of my very good friend's brother. And he was getting into stocks. And it was very, very difficult to convince him otherwise that Tattooed Chef was anything but a fantastic opportunity. Very difficult. And so you can kind of see this if you guys go back to the original videos. And I think that was the approach. And I did that on purpose. So now if you guys are still with me, there's a couple of you subscribers out there that I won't name drop you at all. But a lot of you from the beginning, I remember I got some pushback for my content on Tattooed Chef. But you can see that the strategy I implemented, because I actually did want to, provide you with good information, was not to be, confrontational about it, and kind of just say, yeah, you could be right. And then that's a psychological trick that I implemented, so that if you do actually want to help someone, you try not to be confrontational about the opposing viewpoint, and then you try to present the viewpoint there, and then you let them do their pushback, and then you just take the pushback, and then you just continue. All right. So the goal, and as long as I can start to hopefully reach more and more and more of those followers of that person, and kind of show them that, one, they don't need to pay that individual for their course. That is again the motivation for why I want to release the free course, and or pay what you want course. Because fine, I'll accept the donation, but the idea is the main people who probably need courses are people who maybe didn't, can't afford, to get into this stuff in the first place. So, but yeah, we're getting sidetracked. The point is, the thesis was fairly simple, straightforward. It was revenue growth, and I think for most of you guys, it's fairly obvious, right, that revenue alone does not pay the bills. All right, so yeah, Tattooed Chef, we're closing this off. That's it. All right. What was the other one we were gonna do? Oh gosh, and I said I wasn't gonna forget. I didn't forget about oh gosh, I did forget. I did forget about your stock. I'm trying to remember. I'm going back up to see if I find you. Oh, I didn't see this one. I didn't see this one. In your discussion with Carson, did Carson apply his 40 multiple of earnings before they were discounted? If he did, be a flaw in his valuation. I actually should have asked. I'll rewatch the video. I think we discussed. I just don't remember right now. So if I answer this question now, I won't answer it truthfully, and I want to avoid that. I want to answer only as accurately as I possibly can. Okay, so I'm so sorry if I forgot your stock. There was some stocks that I think were BBC is holding up. All right, you know what? I'm just gonna do it. I don't actually know this ticker, so I'm actually terrified that it's something else. Oh, okay. No, I didn't do Zillow. I'll do Zillow for you right now. So Zillow. All right, so but we'll talk about Zillow. I tend not to. Oh my gosh, what the heck? Oh, there was one stock I'll actually showcase here tonight. It's not something I'm buying, but let me see. I'll pull it up. I gotta find out what the ticker is. Let me see. Top movers. It was a big mover today. It's a hospital provider, HCA stock. HCA. Let's pull this one up. Our HCA, and then we'll go back to what you guys are asking for. So HCA is down 21% today. Many of you might not have even heard of this company. And okay, fine. I'll also look at SNBR. I think that's the one I forgot. And okay, CRM. Well, actually, no, CRM is going to have its own video because it's on my watch list. It's going to have its own video, but I'll do brief discussion about CRM, but it's going to have its own video. So, yes, HCA Healthcare hospital provider, quite big hospital provider. You can see the market cap here is about 64.97 billion, P ratio of 9.96, dividend yield about 1.06%. All right, taking a look at the 5 year, they did actually do pretty good over 5 years. So you can think, okay, automatically my brain goes hospital provider, stable business, right? You would think so. You would think so. But I actually took a brief look at their earnings report. And it appears as though they're getting squeezed on the ends for labor in particular. Labor's crushing them right now, and so that's a big deal. By the way, for those of you who don't know, the doctors don't actually work for the hospital. I used to actually I had a little bit of a background in paramedics and EMTs because there was a time when I was interested. Again, like I stated, I wasn't a biomed major before I switched to accounting and finance. A little bit of the discussion we were having in the beginning, but so that was an interesting tidbit that I didn't know back in the day, and then I learned. I don't know if that's true for all states. It might be different depending on where you live, but at least where I live, that's the case. So they're more like contractors to the hospital, and so a lot of the employees, I'm assuming, right off the bat, is probably like the nurses and all the staff, all the other staff. So typical, wage stuff going on right now that you guys have heard of. All right, so now we're gonna go into Elemental, I did not look into them yet, but they are going to both have their own video because they are a good case study. I'm just trying to get through everyone and working my jobs, working jobs, man. But yes, because work fluctuates in terms of how many hours per week. So because depending on the activity, the level of activity dictates how much work there is. And sometimes some weeks I have more work, some teams I have less work. Okay. Okay, so I'm trying to make sure I cover everyone. Do you have any preference on video or AMD? I prefer NVIDIA, but AMD looks like it's going to get to the better price first. All right, and I'm going to do Zillow now. So Zillow, the reason why I don't make videos too much on Zillow is because it's on this side of the portfolio. This is what I call the dark side. And I see there's two of you right now, but obviously you're anonymous. But there's two of you actually watching the portfolio right now. And it is a public portfolio. There's no paywall. You don't have to pay like other channels to see their portfolio. And here we go. And actually, very recently, because liquidity crunch is sort of continuing here, it appears, these positions are getting absolutely ransacked. But because of allocation, it's not really, hurting at all. So the reason why companies make it here, except for a couple here, and I'll explain them in a couple because some of you probably knew, just in case. And again, people might watch this after the fact. So I like to not leave people in the dark. So Overstock is a legit potential speculation, right? Speculates out of the portfolio. Zillow Group is a legit speculation. That next one, I don't make videos about that one because if it's a microcap. That one is a hedge of sorts. BurgerFi, completely fun, not really speculation. Barbecue Holdings, that's more speculation. Alibaba, Tencent. Well, Tencent's no longer in there because it actually was sold for Prosus down here. Those two are for accountability. Okay. And Greenwich Life Sciences, speculation, but also kind of like a feel-good stock, right? But not really any thesis whatsoever. Don't condone it whatsoever. In fact, very likely goes to zero. Corsair Gaming, just in there because of YouTube accountability. Because when it was closer to $30, I was like, I will buy like some if it reached 21, because a lot of people were saying it would never go down there, and so it did. And now it's look where it is now. Look at where it is now. But it's nothing. So these negatives, you keep in mind weightings. Weightings are very important. So in reality, I have this one as a speculative, this one as a speculative, this one as a speculative, this one as a speculative. Well, speculative fun. This one as a speculative. These are not speculatives, really. This one speculative. This one's gone, and I keep all old positions. I don't remove old positions even when I sell them, because when newer people come into the portfolio, they can keep track of it. So I just have that policy, like, okay, no, and you will see like the final average cost, and it won't actually be adding to the portfolio's performance because I'm out. Right now, where I'll see the difficulty if I re-enter positions. That will be interesting how I kind of do that, because, well, it should be easy. It's just I just press the update. All right, and then yeah, Prosus replaced Tencent, which is not technically. I can't claim that that's a speculative. It is only speculative in so that I do think a lot of this is right now sentiment driven. But I've gone endlessly about those kinds of things. And by the way, I think you guys would love this. I did receive a comment that was really funny because you guys all know my opinions on the VIEs, saying that my video was on the Alibaba or whatever was terrible because I was recommending people to buy it, which I think you guys would find that hilarious. And this guy was not being ironic. This guy actually believed that. So, and then so I responded. I was like, "Wow, okay, that's interesting." All right. Anyways, okay. So that covered. Oh, I didn't really cover Zillow too much, but Zillow is it's a ball of potential. So Zillow, to answer your question finally, is in here. I do. The thing is, we have to evaluate Zillow for what it is. I think Zillow, for me, it goes right into my rules of something that is speculative. I do not know how much it's going to, what's the probabilities of its success. I do know that if it does succeed, it's going to be great. All right. It's going to be great. So I'm willing to take on that speculation that it becomes what I think of as the Google of real estate, right? I know that's a buzzword. Google of real estate. It's like almost like saying innovation. And, like my rainbow, like hands, I move my hands and the rainbow appears. It's like innovation, right? Well, Google of real estate. Nice words to say, but just as easily could absolutely just fail. Okay. Honestly, I'd be like, okay, why doesn't Google just buy them? Because it's almost like it's a search engine, but for homes. Google, buy them, right? But maybe they succeed, so don't buy them. And I'm willing to, just let it go under. And yes, Julius, Google under 2K is juicy, and do not worry, Dark Knight. I have made a vow. I will not be making any videos on the VIEs. Only ones that exist, they'll just be there. No new VIE videos until which I firmly believe is very possible, because I believe, again, it is sentiment driven, that when the sentiment returns to the positive and they are up, then I will continue to make VIE videos. Then that's when I'll do it. Otherwise, I'm done. All right, I'm done, because I already had my place. Unless something big, okay, I got to leave myself a little bit of a door. Can't blame me for that. I will leave it open if something big occurs. If something massive occurs, any sort of rug pulls, stuff like that, I'll make a video on it. But other than that, done. Okay, unless they go up. All right. Okay. And by the way, when I say the VIEs, I mean to the negative, to the what I believe to be the drawdown. All right. So I see your other thing about CRM, but we're going to come back to that. We're going to do this one first. SNBR. So SNBR stock, because you've been waiting patiently for SNBR. So SNBR. So Sleep Number. So okay. So this, I think, is this Everything Money stock? I want, you guys are such good sources of information, because I can't keep track of it all. But I'm pretty sure that I have covered this through Paul's portfolio, or was it another one? He owns some furniture stocks, which were interesting. That was an interesting video for me to do, because I like those videos. I like to see what other investors are invested in. Okay, I got confirmation. Thank you, Julie. So yes, this is an Everything Money stock. Okay, so with that context, what price, if was around when the individual was beginning to add, but then let's be fair about it, were they nibbling on it, because allocation matters. And I think when I looked at the allocations, or not the allocations, the presumed allocations, it was fairly small, but I don't know. You guys know more than me, definitely. Okay, so this is a little book stock. So I don't like investing, by the way, with broad brushstrokes, which the little book actually does. But it, I guess that's the whole point, though, because if you average it out, you'll do good. You obviously pick some that are terrible, but yes. Oh, he bought at the top. Okay, but did he buy heavy? Did he buy like medium? Like, was it something that he's been accumulating, or was he like, oh, this is like, okay, what do you mean by top? Actually, that's a. I'm just like pulling this up. I'm like, whoa, we bought this top, or was it like down here top? That top is important, but yeah, it looks cheap. It probably looked cheaper back in the day. If I had to guess, this actually was like a low PE stock, and that's why I do not. He went all in. No way. He went all in. No way. No way. $1 million worth? You guys are trolling me. You guys are absolutely trolling me. There's no way. There's no way. I mean, maybe, but like, oh my gosh. You please tell me if you're trolling me right now. Alcohol and Fabio make Fabio susceptible to coercion. All right. So Fabio did not blind. Okay, Fabio did a blind SMBR stock. Oh, sorry, I keep saying Fabio. Oh my gosh, you see, look at that. My eyes are tricking me. Paul did a blind SMBR stock analysis a few weeks ago, and it was said in that video he did not own any SNBR. Well, we want to be careful that he didn't change. All right, he might not own any anymore. Oh, you are kidding. Oh, okay, so he doesn't own any. Yeah, he doesn't own any. We're talking about a very large YouTube channel, so we don't like to punch down, we like to punch up. I'm kidding. And regardless, we don't care about who we punch. We just care about, sticking to what we know. So I will do an analysis right here on SMBR. And so he apparently did a blind study. So I guess don't tell me what he said. Let's see what I come up with. And we're not going to look over here to the left at all, so I don't get influenced by another's opinions. All right, so let's take a look. So it's down about 25% in the month, down about 51% in the year to date, year 60%. Okay, 40. All right, so 5%. All right, so let me just do this. Number corp. Okay. Okay. Go here. Actually, let's look for the 10Q, most up to date. Wait, did I see it? Fuck, I would just go with the 10K. When was this? Oh no, that's more up to date. That's fine. Better yet. Business person financial statements. Oh, la, 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 la. All right, so current cash. Okay, current assets, cash and cash equivalents. Okay, declining, not good. Inventories, but maybe it's inventory problem. We've been reviewing a lot of stocks that had the same issues, expensing a lot of cash to fix up inventories. Okay, so they have kind of supplemented inventories there. Property, plant, equipment. I don't care. Let's go for that debt. Do they have debt? No current liabilities. No debt. Okay, no debt on the balance sheet. That's good. Well, they have operating lease liabilities. That is a form of debt. But not necessarily the same thing. But all right, net sales, control, gross profit. Okay, net income growing, sales growing, but cost of goods sold growing. Well, we would see it here. This is growing. All right, so cool, good. All right, so that's fine. Going down here, cash flows from operating activities, net income. Okay, cool. Net cash profit. Okay, so here's interesting. Okay, cash is good. Purchase property, kind of equipment. So we're just looking at its past, by the way. And again, I'm not looking at your comments, just looking to see if it looks good. And I should have looked because it was so zoomed out. I hope everyone kind of see that. And if I was not being loud enough, let me know and I'll go back and review some of the stuff. But yes, that's pretty much it. We'll go to the model and type in SNBR. Oh my gosh, that's cheap. That's terrifyingly cheap. All right, now let's actually do some analysis. All right, so revenue, okay, below trend line estimate. Estimates decline. All right, we don't take their word for it, but interesting to note that analysts are expecting declines. Analysts are expecting declines. Now they are cannibal. Look at that, cannibals. All right, so let's go up here and adjust that. All right, I think. Oh my gosh, 12.5%. We just covered a stock that did the same thing. AMCX. If you guys had seen that stock, let me know, or if you've seen that video, let me know what you guys thought about that video, because that video we were covering another cannibal buying up all its shares, just buying up, deleting them, buying up, deleting them. So my question is, can they unlock this? Cigarette butt investing is very dangerous. It's very, very difficult. It can be very lucrative. Let's be very clear. Warren Buffett really made a lot of his lion's share. And ignore these price targets. Look at the growth rates. Ignore that, please. Don't look at that. But Warren Buffett made a lot of money in cigarette butt investing. Oh, and we got to actually remove this because we're doing some random analysis here. No. So we remove that. Let me make sure we're not doing anything over here. Nope. Okay, good. All right. So now we're in business. All right. So we're going to come back to that growth rate. We're going to ignore that. But these growth rates, let's just delete them. All right. That's how cheap it is. Basically, well, I don't like that. Let's be like, actually remove it. Let's say they can't do it anymore. So let's increase our margins of safety here. Let's see how like insane cheap this looks incredibly cheap right now, but automatically like, yeah, if we assume some 4% decline, yeah, but that's I would need a high margin of safety for something like this. I would not be comfortable with like anywhere close to like a 12. No, sir. Heck no. Are you kidding me? That's insane. Yeah, you see, like this is ambiguity right here in both measures. Ugh. All right, so no bueno. Ambiguity in both. I don't like that. So ratios. Let's take a look at ratios. Let's pull up full time period. Let's see the story. Oh, and this is, by the way, a good way of understanding this. Accounting, you produce these financial statements. Finance is just analyzing, and I like to say finance. You need to derive a story, right? What is the story here? So I'm reading the story from this, and I see that what the heck? Wait, something is reading wrong. Let me go back here. What the heck? Wait, whoa. Let me go back to this balance sheet. Did I miss this? Did I miss this? Current liabilities, borrowing under Oh, you little sneaky freakers, little sneaky freaks. Mm. You have your debt there, you little fucks. You little. So, yeah, they have a revolving credit facility. That is debt right there, and that's a current debt. And they're probably rolling that over because it's going up and up and up. Oh, that's not good. Tax and sales withholding. Yeah, thank you. You see the model. You caught it. Good boy. Good boy. Model's like a dog. Good boy. Yeah. All right. So let me read this a little bit closer. Compensations and benefits. So I don't care. Customer repayments. Yeah, that's unearned revenue right there. But accounts payable. Okay, that's fine. It's growing. It's growing a bit. It's growing a bit. I just don't know exactly the details. What's going on? Oh yeah. Wait. Let's go down here. Net sales, operating expenses. Okay, what are you doing here? General administrative. What are you doing here? Okay, nothing out of the ordinary. Research and development. Okay, whatever. Operating income. Okay. Net income. Okay. Oh yeah, here. Stock-based compensation, repurchase of common stock. Oh, whew, that's a lot. That is a lot of repurchasing going on. I'm guessing that's in millions. Betting that's in millions. And that's 18, 19, 20, 21. Absolutely. Every single year. Boom. Well, I'm looking at this line item, by the way. I don't know. I was highlighting this one. I'm looking at this one, just to be clear. They're purchasing about a predictable amount of 3 billion. Is that 3 billion? Oh, it's in thousands. No, never mind. 3 million. 3 million. Well, how big is this? Yeah, is it in thousands? Yeah, I'm pretty sure that's in thousands. All right. And this is repurchase a common stock amount. Okay, so yeah, that's 3 million, 3.7 million, 3.6 million, 3.2 million. All right. So thank you for catching that. And kind of looked at that. Okay, so they have some debt. It's just not long-term debt. Long-term debt ratio. You're picking up something there. Why are you picking that up? Oh, it's part of their leases. You're picking up their leases. I know what you're doing. Thank you. So good job. You picked up something. But also, let me tell you the story. So the story kind of so far is deterioration. We're in a deteriorated state. It's kind of like a end of life cycle business, buying back as many shares as it possibly can, surviving, kind of just sticking, not really going anywhere at the very close moment. Of course, model's uncertain if it'll go bankrupt within the next couple of years, but that's fine. Total debt ratio. Okay, cool. Interest coverage. Oh, okay. Well, I mean, deterioration. ROA, ROE getting worse. ROA is getting that's stagnations. I wouldn't really call that crazy deterioration. I see improvement from 2019, and ROE is probably negative because they have negative shareholders' equity. Let's actually go back here. Balance sheet. Where are you at? Assets. Shareholder deficit. Aha. Ha 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 ha. Yes, you do. You have negative shareholders equity, everyone, right here. Look at that. Negative shareholders equity. Cool. Accumulated deficit, total shareholders deficit. Boom, boom. Yep, there we are. There we are. What is going on? Operating lease liabilities and okay, so never mind. I don't care about that. Undesigned preferred share. Oh, there it is. There it is. We have preferred stock. Preferred stock's another debt, ladies and gentlemen. Ladies and gentlemen, we have more debt. We have more debt that is hidden. Uh-oh. Uh-oh. See, this is like something that I go see if I'm now looking, by the way. Go see the video and see if this individual who reviewed the stock spoke about this debt. Okay, this is debt. Okay, this is debt. There's quite a bit of it on here, actually. If we actually take a look, yeah, that's 5,000 authorized shares, undesignated preferred stock. I mean, that's there. That's waiting. That's a waiting. It's not really contributing right now, but it's there. No shares issued and outstanding, but it's there. At any point, that's like. So let me be very clear. It's not active, right? but it's there. It's like a looming thing. Michael Burry has actually spoken a lot about that. If you read his letters, he talked a lot about having those things authorized. Very like out of left field. Makes things a little bit more risky. Can make them because you got to think about it. Is the business likely to enter a place where they might want to just start going crazy bananas with debt? Perhaps, right? Perhaps. And I see some of you but yes, go check out to see if the debt was even being talked about, negative equity was being talked about. Those are things that are kind of important. But yes, and just to answer your question here, WP Will P. Sorry, I'm keeping an eye to see if you have any questions because you were the one who asked for this one. So to respect, to keep adding, hopefully adding more and more value to you. I want to say that it depends. So the strategy behind the buyback and negative equity, they're trying to maybe be a cash cow. The management understands, like if I was put in management shoes, right? I don't know necessarily I would want to be the CEO of this company, but let's say I am. So I have a responsibility to you as my shareholder, hypothetically, if you're a shareholder. And then I look at my options as to how, and this is me trying to be uh nice, I'm actually trying to enrich you, my shareholder. I'm actually trying to have a fiduciary responsibility to you. What I'll do is I probably would do the same thing, try to buy back some stock, under the understanding that if I were to reinvest this back into the business, probably won't do any good. Maybe I would have probably opted for a dividend cash cow policy, but maybe they're kind of hoping that they can buy back so many shares and at some point in the future, I've seen this happen before, where then they start issuing a dividend after so many shares are bought back, because the dividend liability, so to speak, is less. But anyways, let's get back to the model. This is so interesting. I'm interested in this business, not like in an academic sense. So ROIC is kind of the same thing. They have negative equity, so it's appearing very bad. Earnings quality, though, is there. It's good. So I'll give it that. Free cash flow margin. Okay, it's fair. All right, so let's go back here. So now let's get into it. I think a 12% discount rate is not adequate for this. A lot of things can go wrong, and I think this has shown that, right? So if you were discounting this at 12% and it was around there, right, around here, yeah, you're down about 42-ish% at those prices. Now, but that's assuming a negative growth rate. But I think, like, let's get to the 15. So 15, and let's actually put this guy over here. Or no, let's put him in the middle. Let's put him in the middle. That's a middle assumption. And let's say they kind of grow at 2% assumption. And then they can grow probably like a decay of like 10%, right? So 10%, they're basically priced for that, right? Now, this is the thing about an analysis. You have to take into account the risks that can kind of jump out of nowhere. And that can come from, debt's one of them. I really enjoyed actually just kind of going through there. Oh, and I see some comments. It's massively shorted. Okay, so the stock right here, the stock is massively shorted. Maybe the company plans to cause a short squeeze with the unsustainable buybacks, and then issue more shares at the top to rule out? Yes. Giga Chad moves like that? Absolutely. In fact, if I were the management, probably that'd be a strategy that I would look at and consider heavily if looking at what happened with the whole short squeeze stuff that we witnessed. Okay. SMB. We talked about Nvidia actually earlier in this, but I will be doing a video on Nvidia and probably AMD together because they kind of go hand in hand, in my opinion. All right. But what is the percentage of it that is shorted? I'm actually curious. I mean, I can pull that up here, to be honest. So XNBR, let's pull this up. So wow, 18%. Yeah, it's pretty shorted. So that's pretty shorted. All right. So probably, you know what? It's probably like maybe a good speculation. Just to like have it in if that's like the thesis behind it and that, there could be like a short squeeze, but in the full understanding that something out of left field could occur here. There's a lot of concerns that at least I have. But yes. Yes. All right, so NVIDIA, people must have the napping. Is that as highest? Yeah. No, I think that was kind of a function of the liquidity bump, right? We're going through the liquidity crunch, and we're still going through it. Like I said, I don't know when it ends, right? And kind of evidence that we're going through that liquidity crunch. Look at like what I'm calling the YouTube index now. I'm kind of instead of just saying all the name of those stocks, we're calling it the YouTube index. So that is kind of evident that we're in the middle of going through it. We're not at the end of it. And I think my personal opinion, if I had to make a guess, and Tesla would be a barometer of where the end lies, or maybe it's not. Maybe we kind of kick the can down the road, and then we kind of get a reflation a little bit. Then it happens, but that's just speculation. We're not going to get into that. Okay, so Nvidia around 40. I'm a buyer. Yeah, that's a big drop. But probably if I had to guess. I'll, I'll load the fucking boat. Oh, yeah, that's good. All right. Like Paul, I like Paul because he was the first YouTuber to make value investing make sense to me. But yes, all EM guys are very shallow in analyzing companies. I would say to you, Will, this is my opinion. Just my opinion. I don't agree with the whole designation of growth and value. I think that all investing is just investing, right? Investing, and value investing per se. I think the definition should be changed because it's perspective. It's nuance. It's depends. What the heck is going on? Or is it growing a lot? Is it decaying? All that kind of factors into that end designation of is it value or is it not value, right? And growth investing is I just don't like the definition because the textbook definition of value investing is like this: low PE, low price to free cash flow, and you just buy those, right? And I just don't agree with that. I think that's a how do I say this? It's not a good way to go about it, right? So, like in my portfolio, I have a mix of what is traditionally considered value and traditionally what is considered growth because I don't believe in the distinction. Um, but yes. Oh, sorry, my neck there. Yeah, those are. Uh, yeah, those are two very good companies, by the way. That's Lamb Research and KLAC, I think, whatever the other name is. But yes. Growth rates in NVIDIA are baked in pretty insane. I would agree with that. Yes. Okay, perfect. So yeah, you already know. All right, you already know. Airbnb. Okay, so this one's gonna be a hard one. Let's see, because I think it's an unprofitable one, and I don't really know what the margin rates are gonna be and all that. So I think it's A, B, and B, I believe. And yeah, are we gonna have to do? No, they're cash flow positive. Heck yes, we can do it. So we don't have to do an unprofitable analysis. Yes. All right. So growth. Let's kind of see. So let me pull up estimations. Growth. Okay, so they're growing like 40, 70, so 70 and 40. So I think, for example, then like a midpoint, or let's say a low point is like 15. I think that's reasonable. And then a midpoint starts to be like, probably like an 18. And then high point's like probably like a 25, like a really high point. Put a 20. Probably should put the 18 there, the 20 there. and the 23 there. All right, so let me come back here. So this is Airbnb, right? I just kind of just plugged it in, and that's not right. That's not right. They did not do buybacks. That's some shenanigans. Did they really? No way. No, no, that's some weird counting stuff. I don't believe that for a second model. You're lying to me. But it is porting in that for some reason. But I don't think they were public around here. So ignore all this. Ignore all of this. I think they were only public here. So ignore that. Um, that's wrong. That's definitely wrong. All right. Anyways. Required rate of return, buybacks, yes. We're not going to ignore that. We are going to actually start assuming some level of dilution because at their stage they'll probably do that. So if we get any dilution out of the window at current prices, of course, if you were kind of expecting a lower margin of safety, there you go, and that's feasible. I mean, they are growing fast. They're growing right now like 40%. I'm basically like cutting that in half because I am assuming it for longer periods of time, and 20% per year is doable from where they are, right? Maybe I would probably say 15% is not out of the realm of possibility. And actually, I would weight it probably exactly like this. I'd weight it 15, 60, 15, 8, and 2. 2% being on the 25%, 8%. So together, 10% being between 23 and 25%. And then based on that, the models are saying it's like not even worth it, right? It's saying portfolio allocation of negative 4.57%. So not worth it right now, right now. And let's actually, why not pull it up here? What's been the stuff here going on? Okay, so it had this trough here. Let's see what it got down to. It got down to 134. And who knows? I mean, who knows? It probably can get into the tens of billions. And I think I think for example, like 50 billion, it'd probably be really worth it to at least take a speculative position in it, that it becomes the go-to for sure. Because of course you have Home Away, which I think is owned by Marriott. Like these other companies aren't just going to sit there and allow this, right? And they're going to use lobbying efforts to try to make it as hard as for Airbnb as possible to operate in as competition, even though the one who gets hurt really is the consumer. That's my opinion, but feel free to disagree on that. Which chart? Which chart? Specifically? Which chart, Bob? Okay. You hold a high percentage of FANG, Facebook, Google, Netflix, and Amazon. Yeah, let's actually see that because remember that this is only my public investments, right? So this is not including like my cash holding. It's just my portfolio, like what I choose to invest in. That's a public stock. And my cash holdings, there's various reasons why I might be holding cash. I might be holding cash for private real estate, private deals, etc. So it's various reasons. And I don't list like private investment. Oh, look at that. You see that, guys? I timed the market perfectly. ConocoPhillips, we sold it and now it's below. Look at that. I'm a perfect timer. Just kidding. Just kidding. But yes. Let me see. You talking about FANG? So I have Google here. Yeah, Google's the big boy, and Google. It's just not. I'm just not selling it. I just don't want to incur the tax. Just not looking forward to selling it. I'm waiting on that share split so I can effectively do. I mean, it's not supposed to really affect if I do it right now, but I want to wait so I can get some more flexibility in terms of how many shares I can really sell at any given time period. That's the benefit of share splits, by the way. If you really get down to it, it has nothing to do with the value or anything like that. It just alleviates, like when I sell, I don't sell $2,300 at a time, for example, if I ever wanted to sell. But I don't really want to sell. I probably will at some point start like a selling call option strategy. Maybe. I'm not, no promises on that. Might even do it for Amazon. I have been doing it for AGRD. I posted a video on that exact matter. If you guys have any question on that, and so far it's doing really good because AGRD is now below where I started selling those call options are, and they expire in the middle of next month. So I made a decent income. It pays for actually a couple bills, and yeah, I will, incur the tax liability, but whatever. It was money that wasn't going to get anyway, and now I got it, and it looks like I'm going to keep the shares and the premium, right? So everything's good, right? For now. Now I say that and HRD rallies, right? But I did an analysis on it and I walked everyone through the process. If you want me to walk you through the process right now, I can go over it again. I'm very happy to do that. The whole point of this channel is to help educate and teach on different things, right? Different topics, right? But anyways, let's look at some. Going back, I get so sidetracked. Just so many things to talk about. But Google, Amazon. Okay, yes, I've Google, Amazon, Netflix, and Facebook. Fang. Who am I missing? Oh, Amazon, Google, Netflix, Amazon, Facebook. Google, Amazon, Netflix, Facebook. Yeah, that's Fang. I have Fang. Yeah. Huh. I didn't even notice that. I don't do that on purpose. Yeah. The more Fang, the closer it looks like BT. Yes, because it is market cap weighted. Yes. And yes, we are still here. Good for you to join us, JP. All right. How's busy season for you? I'm curious. But yes. Airbnb, growth stock, the more Fang, your portfolio has so many stocks, not just buy an index. Why not just buy an index? Well, for me, it's not just my cup of tea. But yes, for most people, yes, go buy an index. Remember, it's going to look more crowded than it is. There's like, for example, 3 of here that are not in it. And I actually consider, it makes it sometimes harder to track. But if you look, I have on the right-hand side, something called partial core. That means they're part of a bigger holding. Okay. So partial core. So for example, BHP and Rio Tinto, I consider them like one holding. All right, one holding for them. I have a couple partial cores. Let me look through them. Okay, this one, Rio Tinto. No. Okay, actually, I think I got rid of the other partial cores, but partial cores do exist. Yeah, I already got rid of the partial cores. And so they're kind of like one position, and ancillary position or supporting positions. They're not really like core holdings. So I kind of have them, and they just kind of sit there. Don't really think about them. Like Boston Omaha takes me no mental effort. I just buy that one, and I just nibble on it. Just nibble. And actually, I should probably nibble on it a little bit more. I try not to talk about that one because that's a micro cap too. But oh yeah, all the ancillary ones don't really take up brain space. It's mainly the core ones, because the core ones do affect me. And by the way, I had a question, which is a really good question. It's regarding some of my core holdings are small allocation percentages. And the reasoning for that is because, like I've stated, the position sizing is dictated by prices. I'm not very emotional about these holdings. I need the prices to be right for them to be at a current allocation. Core is a designation I give to things that could get to large sizes. That's what that designation is for. So Alphabet is a core holding. It can get to a large size. It has. I've let it run, right? I've let it run, and I will continue to let it run. And if it were to come down, I really don't really care. I would actually prefer if I could, designate more capital to that company. But something like, for example, Thor Industries, which I have actually stated, I probably, and I need to actually trim it. I probably should trim it, because I've stated already, and I need to just follow my thought process. If I think that, why am I not acting by my thought process? To be honest, I've just been lazy. But when you consider that, like I stated, I do think that that's an example of a mistake I've made. And some of you have asked me, what are some examples of mistakes you made? I think I made an example of allocating too much too early. I'm only down 6.7%. So it's great that I can acknowledge that mistake and kind of just taper it down just a bit. It shouldn't be reasonably right now 3%. It can get there soon, even up to like 5-ish%. But I kind of went a little too aggressive too quickly, and I need to kind of just like ease into it. So I probably just will take that tax loss harvest super quick, and then kind of just watch it, hopefully in the next month, but not sell it off. I just want to just take it back, right? That's proper allocation strategy. It's responsible. So I've been saying that. I just need to actually do what I think. Not just say it and just leave it there. Adobe is okay. Adobe's down 5%, but I see Adobe. That's a good example of good allocation, right? So Adobe's at 1.2%, and you see how it's a core designation. This is a really good case study. Core designation for Adobe down here. It's at the bottom. Oh, wait, can you guys see it? Yeah, you guys can see it. All right, so core designation for Adobe, but you can see the size. Absolutely would not feel it if that went bankrupt. If that went bankrupt, wouldn't feel it. But core designation means that if the price allows it, it could get up there. And I see a fellow Markel shareholder, the mini Berkshire Hathaway. But yes, trying to do long Markel and Berk B. The thing is, if you own Markel, you own a lot of BRKB. That's their largest holding. So I don't hold any BRKB because I think law of large numbers, they're less likely to outperform as well in the future, but Markel's still a good size. But that's just a quick thought process. And through Markel, you get exposure to that. But yes, oh my gosh, that's brutal. That is brutal. Are you tax or audit, JP? Because I know you're in a different jurisdiction. So if you are taxed, that might dictate, when your busy season is for tax. But if you're audit, oof, you don't have to tell us too much detail because I know you can't get into that kind of stuff. But okay, so yes, Verizon. Well, let me actually see. Is Verizon updated already? Let me check. Oh, not that. Wow, what is this? What is this? It's a penny stock. Totally meant to do that. Trying to upsell a penny stock. I'm invested in that penny stock. Ha 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 ha. All right. Anyways, Verizon. Okay, so Verizon. Why do they have negative cash flows? What the heck? All right, let's look at Verizon like right now. I'll do Verizon with you guys. So Verizon 10K or 10Q, whatever. We'll go to SEC filings. I don't know if they did a 10K right now. 10K, 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 10Q. Oh, it was also 10K. 10K. No, which one's the latest? Latest. 10, 20. Oh, wait, this one. 10K. Boom. Wait, that was what? What? Didn't they just report today? 2022. Let's go. Annual report? No, yeah. This oh, I want your latest one. Don't give me this. All filings. Thank you. Give me a thank you. Apply filters. What? Fine. I'll find you elsewhere. I know where to find you. You think you can hide from me? You think you're gonna hide from intoxicated Fabio? Just kidding. All right. So pull your forecast for me. Pull your forecast. Small cap index. Okay, so might as well just let's actually just pull up their 10K and then I'll kind of just talk you guys through the exact. We'll pull up the PDF. I like the PDFs. Financial statements, financial statements. All right, and then we'll see what's kind of like majorly changed. And I see you answered or you asked the question from the perspective of dividend investing. No. Oh, and I had a question. I guess I'll address it here because I guess a lot of you will appreciate this. The debate between dividend and buybacks. Okay, so real quick poll before I get into it. Comment into the live comments. Are you a dividend investor? Are you a buyback prefer? Okay. So are you think if any of you knows the Giga Chad meme, are you a casual dividend enthusiast or are you a buyback fan? Right. Let me know. All right. And then I'll kind of just go over this. Bill Gates shorting Tesla? No, I did not hear that rumor. My gosh, that'd be such so much tea right there. All right, so operating revenues, total operating revenues. Okay, so operating revenues is actually rising. Interesting. I mean, it's to be expected. Well, we had a decline there. I use AT&T personally, in case you guys were wondering. All right, the answers are coming in. The polls are coming in. Can I even enter polls? I know that you can through like the YouTube's version. But yeah, you can't really do that in this, unfortunately. But has its other benefits. All right, buybacks. Mostly people are saying buybacks and dividends. I think we have buybacks over dividends. Okay, so we're getting there. Buybacks. Most people are buybacks. Look at that. All right, so let's see assets. All right, this is what I was looking for. So we're gonna see this is as of December 31st. Okay, so we got to keep that in mind. And then I shall have this up here. Financials you have reported. Net income. Okay, let's go to balance sheet right there. All right, so I'll have them up pulled side by side. Now let's see if the stuff is up to date. All right, so have you updated here? If you haven't updated here, then the model has not updated. Total assets. Where's total assets? 366. Nope, hasn't updated here. So it definitely has not updated in the model. Didn't Verizon like just report? If they did, yeah, hasn't updated in the model because it hasn't updated there. And this is why, because they haven't even posted it. You have to post it. If they post it, then we're Gucci. All right. So let me see if nothing crazy happened to Verizon. Let me just make sure. I'll just get the quick glimpse. Okay. So trimming full year forecast. Okay. So they trim full year forecast by how much? Like that matters. Customer gains on AT&T, but customer losses on Verizon. Okay. Interesting. All right. So let me actually go to this debate here: dividends and buybacks. Buybacks. Fabio, would you do a quick analysis of your model on a stock? I'm absolutely getting cheeks clapped on. I have requested it before, but it looks absolutely stupid. You can remove it from your list. OppFi. No, we'll do it right now, Patrick, because it's on the list. So then I'll do it now, and then we'll take a look. So OppFi. But I'm gonna put it here so I don't forget. But first, we're gonna do. Oh yeah. Oh, okay. There we go. This is it. By the way, confirm to me that this is the company, and then we'll get to this. All right. So, but yes, doing kind of a look on Verizon. Yeah, the model's not really going to update it, so I'll kind of just wait on that. And to go into the dividend discussion, and I'll just keep OppFi here open, and then fine. I saw. Fine, I'm going to do it. I'm going to do Ricks. All right, I will do Ricks right after this because Julius has asked for it so many times, and I've always brushed it off as a joke, but I'll take it very seriously right now. We're going to look at Ricks today. Uh, we're going to look at Ricks today. I got to say with more enthusiasm. All right, so let me go. So buybacks and dividends. So I think it's interesting to note that most people, visually, I see that buybacks are winning in terms of the popularity debate. And I will say that I would be kind of cautious. I understand why a lot of people like buybacks. A lot of people like buybacks because it's tax efficient. However, if we kind of take a look at it or take a glance at it, and I think the argument is a little bit more nuanced. I think most of you probably have heard my opinion. My opinion is that buybacks are better if, and then there's a big star on the if they're executed right. And you know what? Cop out. Let's go to a company that shows what happens when they don't execute them right, right? You think this is the only one, right? We got more. We got more on this list, right? We got GE, right? We got more, right? So General Electric, take a look at this guy. This guy did buybacks galore, right? Buybacks for days, so many buybacks, right? They're just executed terribly. So buybacks are absolutely destroyers of shareholder wealth when they're executed poorly. Now, then ask yourself this: how confident are you that management is going to do effective buybacks? Now, that depends on the management. For example, if you have Warren Buffett as your freaking, CEO, well, great. You're going to do great. Berkshire Hathaway does very selective buybacks. I like that about them. Execute it very well. Markel actually probably does also very selective buybacks. It's companies like Apple. Apple was a little bit of a different story because there was an arbitrage in terms of their credit facilities, in terms of how they were, they could get capital and the yield of their own stock. And it was incredible. Like it's because, people would lend Apple money for nothing, right? So there's a little bit of nuance there too. But yeah, buybacks tend to be more capital efficient. I would say there's a mix of the two. And I saw one person say dividends as long as they're in a tax advantage account. Yes. So the other thing is dividends, when you receive them, they are realized immediately in terms of their value. There is no fluctuations. There is no possibility of market fluctuations changing the supposed value of that return of capital. Because let's say you do the buyback today, $200 million, right? That $200 million, maybe tomorrow or in a month or in a year from now, it gets cut in half, right? Because now, if you had done the same buyback, now you'd get more, bang for your buck. But the dividend of the same capacity would generate basically the same, right? But right then and there, right? You'd get it then and there, it'd be realized, and you could take that cash, you could do whatever you want with it. Of course, ignoring taxes. Taxes is probably why. If taxes probably wasn't an issue, I guarantee most of you would be like, yeah, yes. Or if you guys lived in Australia, because if you guys don't know about Australia's taxes on dividends, oh, they're amazing. I wish we would do that here. But anyways, there are a lot of benefits to dividends, and actually a lot of studies show that dividends are, and I'm trying to be, unbiased. I don't really care. I think it's like more, for me, it's more nuanced. It's like, well, it depends. And I think most people would probably agree with that after that little tidbit. All right, so let us go into OppFi and let us confirm. What is this? Moving up 4% today. It's mooning. Okay, so let's be serious here. So it's from $10. Was this okay? Right here, I can already tell this was a SPAC. All right, this was a SPAC because now you guys are all old enough. You guys are all old geezers. You guys lived through this. So you lived through the time of the SPACs, the era of SPACs. And taking a look here at OppFi, right? You remember when these SPACs were going around, they were always at $10. That represents like the capital that they have to invest. So it's SPACed out, and look at all the SPACs that are doing terribly. Look at these SPACs, right? Let me show you these SPACs. Take a look at this. I have this SPAC. Is Corsair a SPAC? No, Corsair was not a SPAC. Was it a SPAC? It might have been a SPAC. It might have been a SPAC. But Corsair might have been a SPAC. I know that BurgerFi was a SPAC, and BurgerFi's sitting at $4 here today. Tattoo Chef was a SPAC. Now Tattoo Chef is under 10. SoFi. Oh, we didn't talk about SoFi. That's another stock I want to talk about because yes, we're going to talk about SoFi, but after OFI. Don't worry, OFI. All right, so let's go to OFI's website. Let me remind myself what it is that this does. 150 million Americans. Okay, so finance. So that's where the FI comes from, finance. Our mission, we empower everyday consumers to rebuild financial health through financial credit access, enabling savings, building. This is exactly what you want to own in the midst of a recession, right? Or in the point of a recession. Obviously being, facetious there, but consumer credit. What is your thing? Consumer needs need access to credit. So this is very dangerous. This is a very dangerous business line. Consumer times here. If consumers have less than $1,000, are you a bank too? Are you a bank too? Oh, have denied a line of credit. Line of credit's dangerous. There's a reason why banks don't do this. There's a reason why banks do not do lines of credit anymore. Who is locked out of a traditional credit and has been denied a personal loan in the past 5 years? Yeah. A lot of the bigger banks don't want to do lines of credit for reasons. All right, let's do products. All right, products. Op loans, OpFi. Op loans by OpFi. Salary tab. Okay, so this is this is what I'm going to get to with SoFi. Very similar criticisms. We'll get to that. But remember this, salary tab. Salary tab is indicative that you kind of target lower income or higher risk, because maybe there's instances in which people who make good incomes would maybe want to use this, but typically this is when someone is facing hard times. Unfortunately, it happens, and they might be facing hard times. But yes, via payroll deduction with no additional fees. I like this word, no additional fees, but they obviously take a percentage than the OfFi card. Okay, so OfFi loans, okay, so these are 3 products. So it's kind of like payday loans in some instance. Now, if I go to investor relations and I go to their 10K, or not 10K, you always say the 10K. Hey, we got the sales pitch. All right, so you put it front and center. Can we make it bigger? Oh, all right, all presentations. No. We'll be quick with this, but just viewing their presentation. Oh, it's just a lot of numbers. It's not really a sales pitch. It's kind of just, here you go. But cool. We don't have to go to the 10K because you just look at this. All right. So interest and other income. Okay. So interest, loan. Okay. All this dangerous. We're going to talk about that when we get to also not SoFi. Voyager Digital. I will do a video on Voyager. I am so excited for that video. Oh my gosh. And the amount of people just going absolutely, I don't know, just insane, right? Just insane over Voyager and SoFi, right? That's a really good joke. For those who don't know, it's a reference to how complicated GE's business is. Insane. Yeah, it's absolutely crazy business. Yeah, you can kind of see there. That's exactly what I'm talking about. So, I own Facebook and I can call them out when probable. Like, yeah, that was bad decision in hindsight. Obviously, that was shareholder destruction right there. We're not getting that money back. That money should be used now to buy back shares because they bought it back. A good way or a good barometer, obviously, like this is assuming you're right, but good barometer is like if you're not buying the shares, why would you want the company to buy back shares? But yeah, okay. So going back to this, so this is dangerous. Total debt. Well, this is a consumer lending. So company. All right. So I kind of hope that like this is going to be pretty difficult to like derive a value to, if I'm being honest. Not going to be very easy, but for the I forget who requested it, but whoever requested it, I hope this so far is good. Okay, so analysis in your model. Okay, you want me to do it in the model though. Okay, so I will oblige. Let us oblige, but it's not going to be an easy one. What the heck? What? I'm so confused. Are we looking at the same thing? Are you loaded in, right? Oh, it is loaded in. Okay. Well, I'm hesitant, but almost wait, whoa. We're not doing this. We got to do this. Yes. Okay. There we go. I was like, something's wrong. Something is wrong. Now I know what's wrong. All right, so good. All right, so yeah, this is priced pretty chilly, but here's the thing: you must be going nuts over here, right? Because that's what you really need. So growth rates. Let me actually see if we have any to kind of growth rates to go off of. Do we have any growth rates? Okay, so that's kind of like what they're projected to grow. They're projected to grow about like 20-ish% next year. So more or less in fair value. But how much have they been diluting us by? Kind of flat. That's fair. Kind of flat. Yeah, kind of flat for now, but I'd rather be more on the conservative side. So that kind of gets us there. It so at $10 it was insane. That was absolute insanity. But like now, if you think that it's going to survive, right? If you think it's going to survive and it's going to do fantastic, then great. There you go. But it's less risky. It is less risky. I'm not saying it's not without risk. It's less risky. That's about it. Definitely not my cup of tea. I would not be. I wouldn't want to buy it necessarily right now. But yes. Mm. Okay, so yes, we are going to do Ricks. And oh, wait, should we do Sofi? No, we're going to do Ricks first. We are going to do Ricks. The people have been waiting for Ricks. Okay, so that's the ticker, RICK. Okay, we're going to let that load. We're going to come back to this. We're going to come back to Ricks. All right, Rick. Is it Rick Stock? Okay, we're going to do it this way. I've never seen RCI Hospitality Holdings. Oh my gosh, this is hilarious. Let's. Oh gosh, what am I gonna? Oh my gosh, what are we turning into? This is this is escalating. This is getting this is getting crazy. Oh no, what is going on? This is where everyone starts to just leave because things get a little insane here. All right. Anyways, so they own all this stuff. Rick, Soxy Club. Okay, cool. Um, okay, okay. Now let's go back. Nope. Can I not go back? Okay. I guess this is like a open tab there. Brick stock 10K. Let's go to the 10K. Let's see what's up. Brick stock RCI holdings. Yes. Hope you guys enjoy me looking into this. Oh, and I see some people are talking about reverse stock splits. Yes, GE did a reverse stock split. They kind of did that as a little pathetic attempt to raise their stock price, just in numerically, just so they can not be a penny stock anymore. I think were they a penny? They weren't even a penny stock when they did it. I think they were like 10 or 6, between $6 and $10. They were around there, and that can really shaft you if you don't own as many shares as you need in order to kind of avoid or keep your shares. Hold on, my brain can only do one thing at the same time, so she means just like. Have you noticed that? Are there any women in the audience? Are there any women in the audience that can attest to this? Those men cannot, sometimes control or think about two things at the same time. You know, I think it's only fair that this male dominated audience we are finishing. We're not finishing off because we're doing SoFi. We're still doing SoFi. Because I got to talk to you guys about SoFi. But yeah, it's fitting that we're talking about this stock. All right, so we have a strip club here, and it is losing cash. Wait, September 31st. This is unaudited still. This is the most up to date. What the heck? It's unaudited, huh? Oh no, I'm kidding. Revenue. Okay, sales are growing. Look at that. Look at that. Service revenue. Wonder what that is. Okay, so you don't know the names of the establishments. I've actually swear by it, but you guys can don't believe me if you guys don't want to. It's fine. It can keep it the capital mindset secret lore. I've never been to one. And my one of my very good friends, his little brother, really wants to take me. He's of age, by the way. He's not. When I say little brother, it makes it sound like he's a little kid, but he's of age, and he swears by them. Obviously, like there's like Club 11 in Miami, which is like a quasi strip club. I haven't even been to that one. But sure they're profitable. I've seen the movie, not the movie, the show Ozark. Sure, we can we can launder some money. Haha. You hear me, IRS? Haha. All right, so pretty good stuff. Just kind of looking for anything out of the ordinary. Inventories. What the heck do you have inventories for? What the heck is this? What do they have inventories? Poles? Other phallic objects. All right. So, anyways, non-cash lease expense, net income. All right. So let's just put through the model, see what the heck's going on here. Oh, this is not a financial institution. So, oh gosh, gonna break the glass against the mic. So we are no, and we are no. Heck yes, we're gonna buy Reits. We're gonna buy Reits. All right. So there's no price target set. I won't even, whatever, analyst. Average growth over the past years. Okay, so taking a look there. Okay, trend line. No estimates given. So we're just going off of 2021. Shares are kind of stable. All right, we do have a token dividend. PE, price free cash flow. All right, cool. So discount, average buyback. So they have been doing some buybacks more recently. So we'll say like 1%. All right, so are you actually invested in this, Julius? I'm actually curious. No, just like on all seriousness, is this an investment? So, it isn't capital mindset lore until it makes it to the green screen. Absolutely. I will one day, because I just don't want to scare like the newcomers. Like newcomers just come on the live stream. They're like, we're expecting, something to do with the title, and then just see like a strip club. Like I can actually put stock video in the back, just picture it right now. Just picture stock video of a Rick's establishment just back here. And you have like, I don't know, some whatever. It doesn't matter what their names are. I'm kidding. I'm joking. All right, so yeah, looks like an interesting stock. Interesting company, very fun company, very funny company. It would be a story to tell if you own this, right? But anyways, let's actually cover SoFi. So SoFi is the one, the only. All right, so SoFi. So SoFi, I got a comment in the whatchamacallit, in the YouTube channel when I did another video on SoFi. After it had come down a lot, I made an update video on SoFi, and I actually might make yet another update video on SoFi because the comment was really interesting, and it said that, well, you don't know what you're talking about because blah 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 blah. And what was interesting about that comment, the comment did not address any of the points. And not to pick on this person, I'm not name dropping you, and you're not in here, by the way. This person definitely did not like the capital mindset content, is not going to be coming back, and that's fine. Not for everyone. So it was about $9 a share, and this was a secondary video to the original SoFi video, which was done, I think, when it was closer to 20-ish bucks, right? Was it? No, I think it was here-ish. I forget. I honestly forget. No, it actually was closer to $20 because it was like in November. But anyways, that's not the point. Now we're down to about 6-ish bucks, and a lot of the concerns, which we'll address right now. So let's go to SoFi. All right, so here we go. We're on SoFi's page. I want to state what are some of the bullish opinions I've heard on SoFi. All in one platform. Very easy UI. Actually, the UI thing, I'll give it, right? The UI, it appears as though the UI is very easy to use. I don't own an account with SoFi because there's no incentive for me to do so. They don't offer me anything in terms of, and by the way, one of the main theses behind, and I kept this comment up here, hold on. One of the main theses behind SoFi is, they target high net worth, high income earners in the younger category. All right, sure, fine. And then when I looked through this, and I did this in the video, I found that a lot of the stuff similar to OpFi is catering towards not that category, right? So we got to stick to it. Like, what is, and I said theses, not feces. I see that question, theses. What is your target audience, right? And if you're changing the story around over and over and over again, makes me a little bit more cautious. Makes me go, like, what are you focusing on? Please, like, focus on that. And I see, okay, private student loans. That's fine. That doesn't mean that that's for people who are more risk, and you call them riskier clientele. And that's actually, I will finish off because I want to finish off because I have that memory. I managed to do it. Citigroup. We will talk about the banks. And it's a good segue from a fintech bank to the bigger banks. So SoFi, you look through this and you say, okay, well, I look at something like JP Morgan Chase, where I don't care about the interest rate. Do you think I care about the interest rate? Do you think let's take a look at like a very wealthy client, a very wealthy client. Do you think they care necessarily about the interest rate per se? No, probably not. They're looking for, they either have their own business and they're looking for a place to, park their money as an intermediary, and they're looking for the service aspect. And that's what I kind of find to be mostly true. And for example, in Chase, you have JP Morgan private client, right? Private client. So I think that's with 250,000 and above. And then you get, good treatment, et cetera. There's a lot of services the bank can do for you. They're at a call, beck and call away. Already at that level, you're not getting any fees whatsoever. You get your own like box and stuff and all that stuff. I think you don't even need to have that much with them to get the box. I think it's only 15K to get the box, but 250K, you get like this, specialized treatment or whatever. And then Bank of America, I've talked about this in the past. It's almost as if I'm sponsored by Bank of America. Bank of America, sponsor me. Come on. I'm kidding, but not kidding at the same time. But kidding, but like not kidding. So Bank of America, they have it at like 20,000, 50,000, 100,000, but at 100,000 you achieve the highest level, and you can have your brokerage account with Merrill. You see, it sounds like it's becoming a commercial for Bank of America, but it's not, I swear. I'm just like saying from the consumer standpoint. And you get all these added benefits, these added power-ups to being like banking with them. And they're worth it. They're actually worth it when you really break it down. Like their credit cards become the best out there with no annual fee when you have that kind of money. If that's like what you care. I look at credit cards as like discounts on my spending. And yeah, but again, responsible use only. But SoFi doesn't have any sort of those incentives that these other banks do. And I'm pretty sure Wells Fargo must have something. I don't know if Citigroup does, so I can't speak for them. But taking a look over here, I'm just looking through this and I see, okay, credit score and budgeting, that's fine. It's fine. Home loans, auto refinancing, insurance, personal loans. So this starts to get concerning. And I think I go here, products, personal loans. So actually some of the stuff is fine, and these are kind of expanding. Wedding loans, like come on. Travel loans, come on. Credit card consolidation loans, there's a balance transfer credit cards, but that's a little different. Home improvement loans, like a little bit on the riskier side, and this is why I like bigger established primary dealer banks. That's what I prefer, because you don't get all this stuff. But yes, interesting stuff. All right. So, and then what I'd say with SoFi, all this risk, right? If you actually consider that potentially they're not going after the top tier client, and when I say top tier client, I mean like the less risky client. That's what when we're in the context of banking, top tier means less risk client, and that could be high income or low income, but people who pay their bills back. And typically, statistically, it is people who generate more income that tend to be, right? And that kind of makes sense because you have more means to do so. So when you consider that and just looking through this, it makes me question that part of the thesis that, they cater towards that category. It makes me think, really, are they? Or are they catering more towards that? And I think they also have somewhere around here, they have like the payday loans. Well, not the payday loans, they like advanced salary. Where is it? Investing? No. Home loans, private student loans? No. Medical, law, refinancing. Where are you? You're somewhere around here. Small business, auto. It's definitely somewhere. I looked at it in the video. I forget it where it is. SoFi Invest. It's probably in here. Yeah, it was somewhere. I found it when I was doing the video. Now I can't find it. All right. Oh well. But anyways, regardless. What is that? Project Zomboid. Huh, interesting. All right. So yeah, that's pretty much covers SoFi. And then I'll kind of segue into Citigroup. But I see some question about SoFi. SoFi is mediocre at everything. It does jack of all. Exactly. That's exactly what I would call it. It's a very interesting idea. Don't get me wrong. Very, very interesting concept. Of course, UI is very important. Let me be frank. I think the UI at Bank of America could be better. It is getting better. Same with JP Morgan Chase. JP Morgan Chase, I think, is worse, in my opinion, than Bank of America presently, as far as the UN Vest goes. Let me be more direct in what I mean. So, yes. what are we saying? Oh, you guys are all talking about price to, oh my gosh. Okay, that's really good. That's, I guess, referring to the other one. But yes. What what is the point of the early pay feature in a checking account? It's getting paid every other Thursday. Really make that much of a difference? Friday. It's still 14 days apart. LOL. That's the point. That's what I'm saying. Think about that. Take that exact idea and then extrapolate from that and say who might be wanting that service. That's exactly the thought process you should take. Will P, you're right on point, right? You're right on point. Who is potentially the customers that need that service? And that doesn't mean it can't be a profitable service, but we have to understand the risks. And again, it doesn't say that the entire company is just complete trash. It just says, okay, well, that thesis about what you're saying regarding, high, and again, we're in banking world. So in banking world, high quality clients means clients who are going to pay you back, low risk clients. That might not stand up to scrutiny when you start to think about it like that. All right. When you're offering or catering products to that. Okay. So that's the big deal. All right. So now on to Citigroup and kind of covering Goldman Sachs as well. But yes, yeah, you see, there you go. Makes you feel warm and fuzzy. And I see that there are some people actually talking about but meet Kevin and said Sofi would go. Yes, he did. So maybe it will. Oh, price. Yes. Yeah. I saw your comment up there. The price to action ratio. All right. HSBC is a foreign bank. I won't really cover them. They're a little bit more difficult, but we'll finish off with Citigroup and we'll finish off with, because we're almost at, we're 2 hours and 30 minutes. Look at this live stream. This is insane. This is my longest live stream so far. All right. So Citigroup and Goldman Sachs. We'll cover Goldman Sachs as well. So Citigroup is in the capital mindset portfolio, and I'll showcase that here. But let me be clear, and just in case no one has heard this before, I will say it again. The only reason why Citigroup is in here is because it is the last one of the banks that has remained. I sold the banks in the end of last year, back when we were still talking about the beginnings of the liquidity crunch. Those were one of the first ones that I wanted to sell. And remember, in all the videos where we discussed the banks, and I kind of was like, the interest rate, because it's a common thing, and I don't say, oh, you're silly for thinking that, because CNBC repeats this all the time. Interest rate rises does not necessarily mean banks will make more money. No, they make money on the spread. All right, so repeat after me. Banks do not make money when interest rates rise necessarily. They make money on the spread, on the spread, on the spread, on the spread. So it depends on the spread. And when we actually saw a bunch of QE and interest rates go down, ask yourself, what did bank profits do? They went up. Bank profits went up. The spread. Pay attention to the spread. So in this liquidity crunch, I practiced what I preached minus Citigroup. I practiced what I preached, and I got rid of stocks that I believed, and I'll actually go over ones that I was wrong on, I believed would not benefit. Okay. And took those profits, just took the profits, and they were very nice because those were a lot of additions I made in prior years. So very happy with the performance. And I had Bank of America, I had Morgan Stanley, I had Charles Schwab, I had also JP Morgan Chase, but that was a smaller position, and I had Citigroup, and I had Wells Fargo. And again, for those of you asking, kind of getting back to that thing, a lot of these positions probably weren't also on here, right? Because some of these are obviously new. I'm adding to them, but I considered them like one position, so they were all like kind of my own little mini ETF of banks, and I just sold them. And the one that stayed was Citigroup, and so it's just because it's here does not mean that I'm like super bullish on Citigroup. You can see it's holding, right? And then I'll explain a little bit about Citigroup. So with Citigroup, you have to understand, this is like a common thing people say, oh, it's trading below book value. Oh, it's it's below book value, so you should buy it because it's cheap, right? Well, we need to understand the quality of the banks, right? The quality of the banks does matter. The ability for these banks to generate returns on their asset base matters. And Citigroup's performance relative to other banks is more or less mediocre. Let's just say it how it is. Citigroup's is not as good. So they don't have as good or strong enough business in their investment banking, and their consumer banking is fairly ambiguous and all over the place in terms of global reach. So that makes them inherently a little bit more riskier, a little harder to understand. Also, when considering, for example, direct risk versus indirect risk, they don't even know. If I'm being honest, they don't know how much risk they have exposure to Russia. They just know the direct risk, but then in reality, there's what's called indirect risk, and that's maybe you're lending to some other parties that are going to be affected by whatever's going on, and then that's going to trickle down into your craziness, and things can get crazy. Okay, I think 2008 kind of proved how connected things are in a lot of extent. So one thing that's maybe not directly on you can really hurt you still. Okay, so keep that in mind. And then Goldman Sachs, similar thing where they're kind of trading expensively relative to where they probably should be based on the type of stuff that they do. JP Morgan is like your bellwether stock, bellwether bank stock. Same with kind of Bank of America. You can see who Warren Buffett prefers. Warren Buffett obviously has made his statement. Basically, he's putting his money where he believes, and that's Bank of America. He believes Bank of America is his go-to. He believes maybe they can be better than a JP Morgan Chase at some point. So we'll see. We'll see on that. I got some comments or questions here. Well, here we go. Banks do not make more money when interest rates go up. It depends on the spread. Yeah, because yes, good, good. So the spread of what they can borrow to what they can lend. That's the answer, Chris. So Fabio, do you always use fully diluted shares outstanding in your model? Is there a case for using shares outstanding, implied shares outstanding? I mean, yeah. It would depend on what you think management's going to do. So that's the thing. It just depends. I know it's a cop out answer, but it depends. And yes, thank you, because I literally was not about to mention them. So Reits. Oh my gosh. So I was incorrect in Reits, and this is very good to point out. I was incorrect in Reits. So I believed that REITs were going to suffer from this liquidity crunch. This is what I missed, right? So where did I go wrong on this? And let's pull up a REIT. Let's pull up like realty income. So I was right until I was wrong, right? So, and I might still end up being kind of right, but let's kind of look at this. So this is when we were already kind of discussing on capital mindset in this general time period about what was kind of thought of as the liquidity crunch, because we had the Federal Reserve saying what they said. And again, if you're Snyder pilled, at the very least, Snyder also believes that psychology can still affect rates, right? Could still actually affect rates. So at the very least, psychology can actually be a factor, and it could be a negative impact, or negative impact on upward positive impact on yields, or negative impact on yields, regardless. All right, anyways, regardless. So realty income, I actually sold, I think around in the 70s. I think it is lower than this. So technically, if I were to buy back, I'd be buying back at a higher price. Let me be very clear. And then so for a while, I was actually like vindicated. So we actually did see a drawdown. You kind of like look at any REIT. So we were right for a while. Let me think of another REIT. ADC, right? ADC stock, right? You see the same trough, same drawdown. Stag Industrial, probably the same thing, right? Yeah, you can see here this little trough. This one still hasn't really bounced back as much, but this one's a little bit more on the pricier side of REITs. WPC, let me see this one. Yep, you see the same draw. I think I'm making my point here, but around February and here, it actually rose up. And I was having a conversation with very interesting person who is a subject matter expert in commercial real estate. And so one gap in my thesis was, and this is perhaps like, again, yet to be seen if I'm more longer midterm right or wrong, but what I wasn't actually accounting for over the shorter term was, and this is again, a really good point to say, this is what happens when you miss a tiny detail in your little macro understanding that can cause everything to kind of not be right about what you're saying. So I was kind of right until the market kind of realized something. And this is actually for those of you who work in commercial real estate, might be able to elaborate on or kind of confirm. But REITs they have very good access to capital. And implicitly, when rates are rising, what that implies, a lot of people think, and I did do the thing is I actually even covered this in the REIT video. If you guys go check out the REIT video, I did cover this, that's saying that it's not always the case when rates rise that REITs go down. It's not always the case. And I literally said that in that video and almost like didn't really like look deep enough into this particular scenario. And so let me not bury the lead. What I missed out on was the ability for REITs to actually have very competitive um, uh, ability to raise capital and crowd out competition that would be crowded out with yields rising. And so implicitly, the investor base, the market might actually enjoy that because it does mean that REITs can now get more deals done and grow faster. And because when we think about it, the more deals they can get done, and as long as they're accretive to the FFO, that's good. So that's a big thing I missed, right? So and it's a point of contention. If rates continue to rise and it crowds out, the private investor, right? So you have your big time investor who maybe could get like, I don't know, like a 5% yield. Not 5% yield, 5% interest rate, let's say. And now, they're getting like a 7% interest rate. Well, maybe the REIT, which is a much larger, more established entity, much, much more larger, has probably a bigger relationship with the bank. They can probably get maybe a lower interest rate than that. And that allows them to make a little bit slightly more aggressive offers, but still be FFO accretive. So, that's something I did miss. And it's something that I showcased again in the REIT video, saying that it's not always the case that rising rates cause REITs to collapse, because a lot of people think the surface level theory behind that is, well, rates go up, rates are competing as stable income against REITs, which REITs are considered to be stable dividend income producers. That competition makes capital flight from REITs go into bonds. Okay, that's one of the reasons. So if you owned rental properties, would you still buy REITs? Look, the beautiful part about REITs is, the lack of work really and the exposure you get. And think of it like this, when you say, okay, well, private real estate is great because you can leverage. Well, these REITs are leveraged. So, you're just owning the entity that is leveraging on your behalf. And you're kind of generating that separation of risk. So in that capacity, it is really good. I mean, some of these REITs have performed phenomenally, like really, really well over long periods of time. I'm sure some of you are well versed in that. And I actually showcased already some stocks, there's some REITs here that are good. WP carries more of like a slow mover REIT, but O has been a very good performer over its life. But ADC is like a smaller version of O. They focus primarily on investment grade tenants, and then Store Capital takes that approach and kind of flips it on its head, and they focus on non-investment grade. Yeah, but they get like master leases, which allows them to basically see the entirety of their tenants' income statements, financial statements, and they can better like not get hit out of left field as far as these changes go in terms of the health of the tenants. Okay, so let me see, and I'll kind of finish off with these questions. REITs have been the best performers among all industries. Yes, exactly, Dark Knight. Exactly. And so you don't actually want to go without having some exposure to them. Or at least I can't tell you what to do. I don't want you to take that as actually advice or anything. But I think that with knowing that fact, it's interesting. And actually, I've discussed the nuances as to why they perform so well. It actually has to do with a lot with the ability to compound, okay? Because they don't get taxed. And so that theory of returns doesn't take into consideration the taxation onto the investor, as do all those performance metrics. So you have to consider that. The compounding effect you see from the REIT performance studies don't actually take into account the tax implications, because taxes from REITs are taxed as regular income. So those returns are actually only true if the investor holds them in the retirement account. But if you do that, then it also might change the performance of, well, actually, no, it doesn't, because the REIT entity is still is not subject to taxation because it's a passive entity. But the C corps that you're invested in, they still are subject to the federal income tax, or their corporate income tax. So if that makes sense. So because the REIT is not being, if you put in a retirement account, there's no measure of taxation whatsoever. That's beneficial to you. And if you think about it from just the entity, how these are measured is basically not assuming or not taking into account the taxation to the individual. So then it doesn't assume any taxation whatsoever. And you can kind of see how that changes the math at the end. That amazing thing. All right, so we do need REITs to crash so we can buy in. I want to buy back into my REITs. I really want to buy. Oh, you know what? I'm not saying it's a buy, but just to give you guys a treat, because I do pay attention to a bunch of different stocks. Here's a REIT that crashed today, and it's kind of in line with that stock I was talking about. Here I said I was going to start closing it off, but you guys asked me a question, you guys make me move. So it's related to this stock that I already talked about. So HCA, 21%, because here's their landlord, right? Their landlord, MPW, they own, medical properties and the like. And then we have one of the largest medical operators, just absolutely getting wrecked today. So then, kind of makes sense. All right. So would you house hack with a REIT? You can't. You can't house hack with a REIT. That's for sure. Have along with energy. Yep. We need to reach the crash. But unfortunately, I don't have any understanding of REIT business model. Way out of my. So circle of confidence. I really say try to get in there and understand REITs. REITs are fantastic. Like just take. I'd say I would say that's to everyone. That's my only real recommendation. Learn about them, right? No harm in saying that. Learn about REITs. Definitely learn about REITs. Oh, and you can do REIT ETFs if you. But yeah, REIT ETFs are all well and good. It has been the best performing sector for quite some time. Doesn't mean it will continue to be the best performing sector, but yes. Yeah, and you see, Julius Caesar is already doing you a solid. He's already coming in here and just giving it to you. So here it is, highlighted. And then we're going to close off this massive live stream. We're almost approaching 3 hours. All right, guys. Thank you guys so much for watching. It was a great time. I didn't even finish it, but these things they get better as slightly warmer they get. Slightly cold, but but yes, it is yeah, it is financial advice. No, but definitely, if you guys want to learn about REITs, definitely learn about REITs. I can make more videos about REITs. I really am lacking on that. Definitely check out the REIT video. It's a good starter, and we compare SRG, Seritage Growth Properties, and Real to Income. But yes, good night, everyone. This is a Good Friday, so I'll see you guys on Strongman Personal Finance's live stream if you guys watch that one. Otherwise, you might see one of my videos again. All right. On that note, thank you guys so much. Have a great night.